Hello, everybody. Thank you. We have a really good turnout today. We appreciate everyone's attendance. My name is Richard Addo-Kessie, and we have our special guests that are also joining us, also in the real estate field. I'm sure many of you are also already involved in real estate, and some of you are not, and some of you are just now starting to learn about real estate, right? But the whole thing of this webinar is to how to transfer wealth through real estate. All right. And this is something that has been happening for the past few years. I've been witnessing it, being a real estate broker firsthand, and been this information needs to get out there ASAP. And right now it's amazing the turnout that we got right now from the Black community, because this is where it's going to start. It's starting already, but it's things like this that where we come together and we share the information with each other, and then we go and execute. Right, that's the main part, executing, because there's been many clients I've been working with, because this same webinar, last time I did it 2 years ago, and a good amount of people came on board, and happy to say they've made hundreds of thousands of dollars, just from going through the same thing that we're going to explain to you today, right? And the ones who didn't, right now they're looking back like, oh man, I wish I did. So now it's the time to do it again. It's always the time to do it. Real estate has been going on for the past years, and forever. For its land, you own a part of this world, and we need the Black community to go and get more of that. All right, so we have some amazing speakers today, and I just want to go over just the foundation of today's webinar, and then we're going to kick off with all of our guests. So we have myself, Richard, we have Ian Nuamah, who's presenting today. We got Jeff Agyemang, that's presenting, Collins Boakye, Bertrand Moy, and we got a special guest, and we're honored and grateful for him to come on board and open up and, offer himself and serve, Mr. Aaron Charles, who's a real estate developer, Black real estate developer, so we're definitely proud to say that, and, that's what we want to do. We want to connect, all come together and build together. So if you haven't yet filled out the Black Home Owners Forum, please make time to fill that out. The link has been sent in the text area, and it's being sent again. Right, on that form, it will give us a good idea in terms of where you are right now in terms of real estate. Like, what's your position, where you are. And honestly, to be on this webinar, all you need is interest. You just need to be interested. All right, you don't even have to be in the position where you're ready to go and move forward with real estate, but you just have to have interest, right? But wherever you are, if you own a home, that's amazing. Right now, we got to leverage your property to own more properties, right? And if you don't own a home, that's why we're here together. That's why we're pulled together, right? So, let's get some resources together and let's go and get properties, right? And if that's something that's you're interested in, let me, see some kind of response. But you say, yes, I agree, or you want to text something in the text box, but am I on the same page with everyone that's on this webinar right now? Okay, yes, sir. Okay, good. Thank you, Kobe. And I know I'll actually be like the mic is working. Okay, all right, there we go. There we go. Yep, exactly. Thank you very much, Sophia. Thank you, Abby. We appreciate your participation, right? Evelyn, thank you very much. And that's what it's about. It's about participation. We got to participate. We have to be a part of what's going on, right? Because if we're just here to listen for information, that's amazing, but I'm all about action, and I think we need to take these steps forward and actually participate, get involved, jump in, get something. Everyone that's on here right now should have property this year, and whether it's, you're partnered up, it's by yourself, or you're getting another property or whatever. So everyone here should be getting that. So that's amazing. There's 34 people here, so 34 more properties being purchased. Yes, Ian, Jeffrey, thank you, Suzette, Dan, Freema, thank you very much. So yeah, that's what it is. Let's all be on the same page and let's make it happen. So, okay, we have some people that are coming in. Yes, I love this. More people are joining us, to get involved with Black home ownership. Today is the last day of Black History Month, but Black history is being made every day, right? Even Kanye West said, Black Future Month. It's Black Future Month that's going on right now, because we got to make these moves right now, to make history, right? And, that's what it's going to take. It's going to take for, us to come together and build. Yes, Christoph. iPhone. Paula, thank you very much. Thank you very much. All right. So going on to, oh, sorry, people are just coming in. Just give me a moment, just letting them in right now. All right. Okay. Sorry, guys, I'm just trying to, just letting people in here. I'm trying to get to the next part of this presentation. Hold on. All right, give me 1 sec. Let me okay, there we go, there we go. Okay, can everyone see my screen?
Yes.
Okay, good, okay. I was having some technical difficulties, so now, there we go. Where? So you could see my screen?
Yeah.
All right, perfect. Thank you very much. So if you have it, as I mentioned, if you haven't yet filled out the form, please fill out the form. It's here. It's getting sent in the meeting group as well, right? This form is a form pretty much to ensure that this does not only remain a real estate discussion. All right, please complete the real estate investors form for us to properly analyze your situation to determine the best real estate strategy for you. All right, so this is a meeting of action. We're going to take action here today, right? And of course, we're going to get information, but please look at that form. Okay, my name is Richard Addo-Kessie. All right, I'm a wealth creator, founder of Create Wealth Network, right? And the Create Wealth Network was formed together, for like-minded people to come together to create wealth, right? And the foundational principles of wealth, so yes, financial wealth is wealth, but there's also other aspects of wealth, what we've put our attention into, and they're all applied through using the map book, right? The map book, it's an annual program, 365 days that are in the program, and it's a commitment. I call it adult school. Like we have our school when we're younger, but then we enter the real world, right? And while we're in the real world, we got to pretty much have some type of structure, and the map book is infused with universal laws and principles, to make you take action and draw towards you what it is that you are drawing towards. So law of attraction, if you're familiar with that, right? And this program's growing. The Create Wealth Network is growing, and the network is a big part of the program because the network is pretty much, like I said, like-minded people coming together, and with similar goals and visions, ambitions, and growing that, because it's energy. We're just adding energy, to the network, and it's all in the same direction. So all of our speakers today, are wealth creators. They're enrolled in the map book program. We want to do more things like this where we collaborate and we build and we grow. So if it's something that you're interested in, please, take a look at the map book, enroll for a year. At least if you enroll for 1 year, you'll get experience of the program. And, it's amazing. It'll give you a lot of self-discovery, right? And it's infused with all laws and principles. So you'll be familiar with a lot of the things that are going on with the book, but it's meant for you to be a guide to assist you in whatever it is that you're already doing. I'm also a real estate broker, right? And, entrepreneur as well. So the reason for this webinar is that we want to have a shift in terms of mindset where in terms of the Black community is mainly seeing a house as a place to live, right? So we want to shift our mentality to also see it as a business. You're seeing a property as a business, right? Of course, you want your house to live in, that's amazing, but the house that you live in is a liability, right? it's good. You're living it, you're experiencing it. So it's an asset of life, but in terms of financially, it's something that you have to pay out on, right? But if we're seeing houses and properties as assets, then when we're going to purchase them, we're more now looking at numbers, so now it's not as emotional, it's more logic in terms of numbers. And if numbers make sense, for you to go in and for you to grow that asset, right? So as I mentioned, I'm a real estate broker, right? And I've been in the real estate field about 8 years now. And what I've been noticing is that there's something that's going on, and a lot of money is being distributed, as you see here at the table, right? From all communities, right? But I rarely see the Black community at these tables, right? And that's something that really stood out to me. And this is pretty much what I'm seeing. This is us over here in the back. We're not at the table. We don't have a seat at the table, and all these chips are being distributed, and we're standing in the background. Right, and then one of the main reasons why is because we are seeing our home just as a place to live, and not as a business, right? And we need to have that shift as well. Start seeing as a business, so we can sit at the table, right? So, if you own a property right now, you have something that is so valuable that you could now even start from here, where a place to live, and then transition into a business, right? So what I want to go in today is I want to ask you these questions, and I want you to think of these questions yourself as well, right? Would you like to learn how some homeowners are paying off their mortgage in 10 years? How they're paying for their children's education in full? How they're building additional financial wealth for retirement? And how they're helping their children own their first home? And the answer to all is to buy an investment property. Right, so paying off your mortgage in 10 years. Right, so most homes have an amortization of 25 years. Right, so if your current home value was 800,000, right, 20% down payment, you'd have 640 with a 2% loan. Right, so you'll be paying $173,000 in interest over the period of that 25 years, right? And just on interest, right? So in terms of paying off your mortgage, you want to pay it sooner, right? Because the longer that you're paying off that 25-year amortization, the more you're paying out. So you want that to be paid off sooner, right? And then paying for your children's education in full, right? So right now, the most popular way for education fund saving is RESPs, right? But the government matches 20% on the first $2,500 contributed annually on your RESP to a maximum of $500 per beneficiary per year. And the lifetime maximum value that they give is $7,200 up to age 18. So as you're putting in money on your RESP, the government stops at $7,200, and then the rest you're putting in. So over an 18-year period, on average, what the person will save is around $50,000 in 18 years from RESP savings, which they have set for their children to go to school, right? And that's not realistic. 50,000 nowadays is like one term on your in college or university, right? So it's not enough. You can get them started, but they're gonna have to come up with the funds to finish off that schooling, right? And then number 3, you want to build additional financial wealth for retirement, right? Most people are looking forward to their pension, right? But CIBC's survey found that the average amount of Canadians have already saved for their retirement is $184,000, while 19% of respondents have saved less than $50,000, and 30% have no retirement savings at all. Among respondents who are nearing the retirement, which is 45 to 62, 32% have saved nothing. Canadians estimate it takes $756,000 that will provide a comfortable retirement, right? And I don't know here, like if everyone has 756,000 saved right now and ready for the retirement, or you're building towards that right now, you know, and you're close to it, right? Or even halfway, you know, but how much are you building right now? Because that's what you need to retire, right? And what happens is most people don't have that amount, you know, and what happens, they end up having a retirement job, right? And what's a retirement job? It's, you know, when, you know, they're retired, but they still need to work to earn a living, to live in the place that they're living, or, you know, to do whatever it is that they need to do. They still have to work a job, you know, in order to get an income for them to survive. And that's what's happening with a lot of people. They're retiring and they don't have much available for them to actually enjoy retirement, right? So you're working all these years, and then when retirement comes, you should have something that's set, ready to go, and ready for you to go do what you feel and please, right? For all that hard work that you put in, right? So how we do that with a current family home. So if you currently have a home, then what you have equity available in your home. You know, so to use it, for example, right, for $400,000 value, right, you 200,000, which is mortgaged over 20 years remaining on the mortgage, right? So accessible equity that's existing in that property, right, as you see, is 80% of the value of your home. So whatever your current home is right now, right, 80% of the value, right, and then you less whatever the mortgage is that you're paying on that home, right? So whatever the difference of that is, you have available equity for you to use into other investments or other things. That money is your money, right? So just take 100,000 of this for 20% down on a down payment on an investment property, right? So if you use that money to put in an investment property, right, the balance of 400 with the new mortgage secured against the property, right, then it actually compounds in terms of what you get back on that property, right? So for the past 30-year, you know, percentage growth annually is around 5%, right? So if you purchase a home for 500,000, right, and this is showing the power of compounding, right, with a 5% growth after year one, the property increases in value $25,000, right? So now the new value at year end is $525,000, right? But what happens in year two is you're not adding the interest from the original 500,000. Now the value of the property is 525, right? And then you're going to put 5% interest on that, I mean, increase on that, right? So the increase in value now is an additional 26,250, right? So now the new value of that property is 551,250, right? And then we go all the way down 5% down to the 5 years, right? That's 138,141, right? From that initial property that you purchased for 500,000 that you put $100,000 down on, right? And that $100,000 that you had down, you got that from your current property, the current house that you live in, or, you know, a property. The money's coming from a property, right? And it's sitting there, it's just there right now, right? So the difference between the purchase price of 500,000 and the new value is $138,000, 141 increase in 5 years, right? So that's what was going on then, right? in terms of average, we're talking about 30-year average, right? But if we're looking at the past 2 years, right? Because this same seminar I did 2 years ago. You know, some people were on here, were on that seminar. You know, I've worked with some people and we got properties, and this is what they got to see, right? So the graph on the left is from 2 years ago, and the average price of a single detached in each city, right? So now the prices have changed. So as you see, Toronto was 870. Now in Toronto, the average price is 1.2 million, right? Brampton was 700,000 at that time, and now it's 1.14 million. Barrie was 550. Now Barrie's at 1 million. Oshawa was at 570. Now Oshawa's at 900,000. Niagara was at 540. Now Niagara's at 900,000. Kitchener was at 580. Now Kitchener's at 1.1 million. So if 2 years ago, and the people who've done it, and I'm sure some of you actually purchased some property within the past year, 2 years, 3 years ago. So you know what's going on, right? So, but this is what is going on if you just purchase a property. Within those 2 years, you're getting $300,000, $400,000. That's just coming to you because you own a property, right? So now the third point, which is helping your children own their first home. This is really important, especially right now. If we're looking in the news and we're looking at everything and they're saying, oh, how are the kids going to buy a property? It's not going to happen. Yes, it won't happen if we're waiting for them to go and get the property themselves, or for them to grow and then 10 years from now, they're going to go buy the property, right? Because we've seen what happened in the past 2 years, right? So this is continuing to happen, right? I know people are expecting, different kind of bubbles and bursts, but from what I know, real estate goes up, so even if there's a slowdown, it's eventually going to go up. And that's why right now what we're talking about is, we're going to talk about different strategies, because, if you're getting cash flow and the property's going up or down, it doesn't really matter, right? So helping your children own their first home, right? So this is creating generational wealth. Right? I'm so happy. Thank you for everyone that's on right now. We have 58 people, that are on right now. That's my mom just signed in. Hi, Mom. Thank you for joining as well. We're so grateful that, people of all ages and all generations are joining this webinar right now, because it's about creating generational wealth, right? Investing in the next generation. Frank Corbin, he's here in the GTA, and I've learned a lot from him in terms of real estate investing as well. And he has a quote that he says, by 2030, there will be a mass transition in wealth. By 2050, real estate will be only owned by the upper middle class, the rich and the wealthy. Protect your next generation, right? That's from Frank Corbin, right? So that's a big statement, right? And someone says we should help all Ghanaian parents understand this. Yes, Evelyn. I hope you call your Ghanaian parents to come on this. It's very important that we invite them, and give them this information, because the thing is, when there's a collective and the collective is talking about the information, then they'll understand more. If it's just you saying it to them, then they may take it in a little bit, but if they're hearing everybody talking about it, then they'll have more of an open mind. So hopefully you got your parents to come on here, Evelyn, right? And even your children, have your children tune in, right? Because that's the next generation, right? So, and do you have adult children that are under 40 years? If you do, they need your help to own before it's too late. Due to today's cost of living, it is very difficult for today's young adult to save up for the required down payment to buy a home. The average home in the GTA is selling in the 800,000s. 20% of that is 160,000. You may have that available in your current home to give them, right? Because an average salary, let's say for an individual that age or a couple that age, is 100,000, right? So that's 8,000 a month, right? But then they have to pay rent, which is 3,000. Then they got to pay utilities, and then groceries, and then phone. Then they have car payments every month they got to pay for, car insurance, right? Children activities, miscellaneous. When it's all said and done, that 100,000 they're making a year, 8,000 a month is down to under 2,000 a month, right? So that's going to take 82 months, which is 7 years of saving for them to come up with a down payment to own their home, right? And we got to be thinking right now in a mental shift where we're thinking the number of children I have needs to be the number of homes that I have, right? So right now, what's your current ratio, right? What's your current ratio? Ask yourself that question. Even if anyone wants to answer, what their answer is in terms of children and then homes. So if you have 3 children, you can put 3-1 if you have 1 home, right? Or if you have 3 homes, 3-3, right? How many children do you have and how many homes do you own, right? It should be equal, right? Because that's what has to happen right now. We need to be building to where we have a home for our children, right? And our children, they have a home that's set and ready for them, right? Because by the time it takes that 7 years of saving, right, or even the younger ones, that's, you know, it's going to take them 20 years or 10 years plus, right? How can we expect them to own a home? We need to do it now. This is an action webinar right now. We need to start acting now, right? And using something like the map book, you know, is a great tool right now to make you take action, right? So what's your current ratio? Oh, I think we got some responses. Oh, thank you for responding. So someone says 3 children and 0, LOL. 1 child, 3 homes. Woo, okay. We're working on more children. Nice, nice. That's amazing. That's amazing, right? So, you know, you have the same number of children, the same number of homes. You know, like, just all you need to just have it in your mind space, right? Just think that way, you know, and children and homes, right? And then you're going to build, and you will get there, right? So there's a method to earn $10,000 a month cash flow, right? And, you know, this strategy many people are using, right? I want to share this with the Black community, right? And when it comes to real estate, so this is a cash flow retirement plan strategy, right? So what the key thing is, first, what you want to do is you want to acquire properties, right? So you want to go buy them. You want to start buying right now, right? So you're going to get that first property, right? Then you're going to acquire another property. Then you're going to acquire a third property. Then you're going to acquire a fourth property, right? And then you're allowed as an individual owner to own 4 properties. After that, you probably have to incorporate, get business set up and stuff like that, and then run it through a business, because then it is business. But the 4 homes that you own, right? After you own the 4 homes, then the objective is house number 1, pay off the mortgage, right? And you're going to get cash flow from these other properties, right? Because as you own these properties, you're putting tenants in them, right? And they're going to be paying per month. You know, so you're not paying per month, they're paying per month, and you get a little cash flow. You want to work the cash flow. So again, that's when it comes to numbers. It's about numbers over here, right? So how much you'll know how much cash flow you're getting from before you even purchase the property, right? Based on how much you put down, you know, the mortgage. I think we got our Collins mortgage specialist coming up as well. You go more in detail on that also, right? But then you want to pay off the mortgage of house 1. Then when house 1's paid off, then you want to pay off the mortgage of house 2. Then when that's paid off, pay off the mortgage of house 3. Then when that's paid off, pay off the mortgage of house 4, right? So then all that cash flow that you're getting, all of the tenants that are paying rent every month, now that's coming straight to you. You know, it's not going towards the mortgage, it's coming straight to you. So that's a strategy, you know, that, you know, it's possible for everyone. The strategy is possible for everyone, right? And this is a real retirement plan, because this money doesn't stop. This money keeps on coming, right? And in fact, it gets more and more, right? Because you're paying down your mortgage and rents are steadily increasing. Rents are going up, right? So does that make sense to everyone? I just want to, you know, if you guys could just reply or say something, I want to make sure that makes sense. Yes, thank you, Jeff. All right. So we talked about the investment, right? And we want to talk about the BRRRR method, right? Because over that property that you own, we talked about how it increased 138,000, right? That's after 5 years, right? So let's say you hold that property for 10 years, 20 years, 30 years, right? So in 30 years, you know, based on that 5% increase each year and compounding, it comes to around $2,160,000, right? And, you know, what we want to do is apply the BRRRR method, because the BRRRR method is a method that's being used in the industry, right? And, you know, right now we're speaking this language, you know, so that you understand it. And now you could go and research it, learn more about it, you know, and get involved with it, right? You know, we're here to work with everyone as well. You know, again, I post a form here also, right? So you can fill that out and we can move forward. You know, if you have real estate things that you want to do, we're here to share with you. So the BRRRR method stands for buy, renovate, rent, refinance, and repeat. All right, then you're going to buy another property, renovate, rent, refinance, repeat, right? And there's a reason for this method, right? Because when you buy a property and you renovate it, right, and then you get tenants inside, it actually increases the value of the home. So when you go for a refinance, you can actually get a quick refinance because the value has gone up very fast. right? And then when you get the refinance, the value could come out, you could take more money and you could go and repeat the process and go get another property, right? So obviously the first one matters, but if you have one already, now it's time to just get this process going, all right? And get familiar with the terms, right? Get familiar with the terms, doors, equity, interest rates, cap rate, cash flow, get familiar with these terms, as you're building your real estate portfolio and you're growing and creating wealth through real estate, right? So talk about doors. How many doors do you have? How many doors do you have? Right? We're talking about terminology, right? And this is something that we want to be asking you frequently. We want to ask you this often, right? And we want you to ask people this, right? People within the Black community, ask them, how many doors? How many doors? Right? Okay, so see, someone said, how do you pay off a mortgage in this housing market? Would it work mathematically in 10 years? Thank you, Dad. Right? So that's what we're talking about over here, right? Paying off your mortgage, the house that you have is what you have. But what we're saying is get another property right now, right? So you have your mortgage and that other property in 10 years, 20 years, you have the money to pay off that first one. If you wanted to sell that property, you could pay off the house that you're living in because you have another property, right? That's pretty much what we're saying in regards to that in terms of paying off your mortgage. Does that make sense? Okay. All right, thank you. So hopefully that makes sense. So how many doors do you have? I want you to start thinking that. And the doors are pretty much any rental unit that you have, right? Any rental unit that you have is a door, right? And start building up on your doors, right? And that's something that you want to do, and you'll notice starts from 1, and after it goes from 2, 3, 4, to 5. And with your doors too, you could partner with others. That's why we're having this conference. If you see on the forum as well, it asks you on the forum, are you open to partner with other investors, right? And you could get investors, right, to come together, and you guys could own a door, right? You guys could own a door together. That's still your door. You still own that property, right? So, how many doors that you have, go out and get more doors, go build more doors, okay? So are you currently thinking like the bank, right? If you're not, then now is the time to start, all right? Especially if you own a property, right? Because what's happening right now is, most people, if you look at this image here on the left, are sitting on a gold mine. Your house that you're in right now is a gold mine, and you're sitting on it. You just have the money that's sitting there, right? The equity is just growing in your home that you're sitting in right now, right? And you're leaving it there. So you're sitting on a gold mine. So then if you look at this middle image here, the bank is coming in. They say, okay, you don't want to use that money? Okay, we'll use it, right? And then come pick your pocket and take your money, right? And then you see this third image here on the right. What did it do with your money? They sent it to work. Yeah, they send your money to work. So you're sitting on the money, but they're using it and they're sending it to work. So now it's time that we need to start thinking like the bank, right? And putting that money to work, right? Because what they're doing with the money is they're going and they're just giving more loans, right? Because if you look and you go to a bank and you ask them for money, right? What do they say, right? Let's say you had $100,000 to invest, right? And you needed more money, right? If you went in for a business and said, I have $100,000, I want to get a loan of $100,000, right? They would come to you and say, oh, how much do you have invested in this? Oh, you have 100? Okay, we'll match. We'll give you 100,000, right? That's the only way they'll lend you money for a business, if they see that you have money in it, right? If you go to the bank and you tell them that you want $100,000 to invest in mutual funds or GICs, which is what they offer us, right? You're getting offered this. So if you go there and say, I have $100,000, I want that so I can invest in mutual funds and GICs, to say, sorry, we don't do that. Right? Same thing with stocks. If you go and you ask them for money to invest in stocks, they won't do that unless you have money loaned already, ready to go. That's like, a line of credit or whatever that's sitting there. But if you tell them that you want money to invest in stocks, they won't give you money up front for that, right? But when it comes to property and real estate, if you go to the bank and say, I have $100,000 to invest, they say, oh, you have 100,000? Okay, we'll give you 400,000. So they're willing to give 80% of the purchase for a property. Why? Because they know that properties always increase in value over time. Therefore, they see it as minimal risk. And they'll loan you over 80%. with interest to purchase a property because they know their money will increase over time. So we need to think like the bank, okay? Because what the banks are doing with our money is they're investing in real estate. That's what the banks are doing. They're investing in real estate, right? And the reason why they can't offer you real estate is because it's not a service that they offer, right? A bank doesn't offer the service of real estate. They offer mutual funds and GICs. Like that's a service, a product and service that they offer, right? Although they know the best place to put your money is in real estate, they won't offer it to their clients because they cannot offer it. It's not a service that they do offer, right? A realtor is the required licensed professional who is able to conduct the real estate transaction for you, right? So they're just selling a service that they offer at the bank, right? If you see a bank like a business, like that's the service they offer you, right? You go to McDonald's, they're offering you a Big Mac, fries, they can't offer you furniture at McDonald's, right? So it's the same thing with the bank. They offering what they can offer, right? So yeah, so what I want to go into right now in terms of success leaves too, there's, the real estate is the biggest thing right now, and that's why we're here today. That's why we're coming together to get more real estate. And who owns the most of the real estate in this world is the Queen Elizabeth. So they know, and they have the next generation set up and ready to go. So we want to do the same thing and have our next generation set up as well. Hope everyone here is in agreement to that. So really think about the ratio and how to grow, right? So one thing about me, I'm all about giving back to the community, and 10% of all efforts that I do at personally goes back to the Black community and the community that I live in. So other cultures as well, love other cultures as well, and I work closely with other cultures, but right now the Black community, we just want to give, the information, to the Black community so that we could have a seat at the table. All right. So, thank you. That's my time pretty much. We have other speakers that are here as well, want to give them their time as also. And, please, again, if you look inside the chat area, there's a link for the form, fill out that form, right? And in that form, we get a better idea in terms of where you are with real estate, and, how you want to move forward with real estate, and, how we can pull together, come together, combine resources, find different projects, and, as a Black community, go and get more real estate. You have that seat at the table, so, thank you. Right now, we have our next speaker that's coming up. I know it's his birthday today, so if we could even, say a happy birthday. I hope he's still alive. I know he had a dinner that he had to go to. Ian, are you still on here?
Coming.
All right, we got the birthday guy. So are we gonna sing happy birthday or? Happy birthday to you. Ian, come here, birthday guy. So I'm the only one singing Ian happy birthday. Guys, this is his birthday. Him being here is a blessing. We appreciate him. Ian Nuamah, he'll be coming on right now.
Happy birthday, brother.
Hey,
Yes.
Fast to be late. How are you guys all? Thank you so much for the love. I appreciate it. I appreciate it. Thanks, Rich, for having me. Thanks, Rich. That was an awesome presentation. I really appreciate that. So I just wanted to just piggyback off of some of the things that Rich said and maybe start a little bit of a discussion. I'll be honest, I have a little bit of touch points of things that I was interested in, but I wanted to hear from you guys in the chat. Let me know what you guys are interested in discussing. Let me know what you guys are interested in talking about. We have some expert panelists, expert realtors, well-seasoned realtors here that can talk about pretty much anything that you guys desire. And it seems like from the chat group, when I was reading the notes in the chat group, it sounds like a majority of you guys are already exposed to real estate as a form of investment. If that is true, can I get a thumbs up in the chat or a hand in the chat if that is true? How many people here but a hand? Thank you for the birthday wishes. Thank you. How many people here have been exposed to real estate or already have some type of investment property? If you want to throw, thank you, Kobe, for the thumbs up. Okay, Shaz, let's see this, let's see the hands up. Anybody else? Or if you don't know how to throw hands up, come up on here, unmute your mic, say yep. And let me see how many people here, because it seems like everybody's here. Okay, I got Kwazi Asari, I got Abigail Du. Awesome. I see Christoph. Okay, Vivian Afori, Jeffrey Asarifi. So it seems like we have a few people here. Yep, Jeff Agyemang. So it seems like we have quite a few people here who've already started investing in real estate. Awesome. PK. All right. Fremont, thank you so much. Awesome. So with real estate investing, I mean, Bert with the Rockets. Okay, let's go. Awesome. Collins, awesome. Latoya, thank you so much. So with real estate investing, guys, I'll tell you a little bit about my background. My background traditionally is in finance and accounting. I was working 7 years at RBC doing credit adjudication at a very young age, right out of high school. I landed a job at RBC the same year I decided to go into my finance course at Sheridan. And from there, I started working in credit cards, customer service, and worked my way up to credit. So I have a little bit of credit experience. Left from there, then I went over to Nipissing to go finish my accounting degree. So I got that done. And now I have a background in the taxes. And from there, I also was dabbling with a few friends. And we had a group in which that we came together as a synergy to really try to help uplift each other and, rely on each other to invest in real estate. And those are my boys, Kobe, Agyemang, and Asarifi. And from there, we started our real estate portfolio. So thanks, Auntie. Appreciate it. I appreciate it. Thank you so much. So so with that said, I wanted to touch on a few topics that I thought were important to me. I mean, just give a little topic from a tax perspective from you guys to understand about real estate. Again, like I said, I don't have a full presentation done, but I have one that I've done in the past. So let me share my screen. And then I just want to have a quick discussion, just wrapping that off, about something that I feel like is important because it's something that I'm actually currently studying and investigating into. But the decision between variable rates or fixed rates, because I feel like that's a big conversation. If you're not aware, March 2nd is coming. The Bank of Canada is going to have a shift in rates potentially, and what that could mean for you and how that can affect you. I feel like that's a conversation that most of you guys would definitely want to partake in because it affects us all right now as current real estate owners and investors. So without further ado, let me just jump over to a few slides in this presentation and go from there. Okay. And also feel free to, if you need to want to ask a question, put a hand up, unmute your mic. I don't really have a set presentation going. I'm just going to just touch on some few tax tips to be aware of, and then we go from there, guys. So without further ado, let's get into this. Awesome. So let's get real estate tax tips. So, I mean, from a show of hands, and I mean, you guys can come on the mic if you'd like, from a show of hands of how many people own real estate, how many people actually have an investment property as well? How many people have an investment property? All right. Let's get this going here. How many people have an investment property? Let me go to the group. All right. Some people have been asked to unmute. If you have a chance, you want to hop on here and
yeah.
Well, I know for some people, I'm gonna call some people. I know Kobe has one. I know Abby has one. There's a few people. And when you guys are investing in real estate, especially from a passive investment perspective, and you have rental income coming in, one of the concerns that comes, especially around this season, is taxes, right? Nobody wants to pay taxes, and everybody who does want to pay taxes hates tax season, but just want to pay only their fair share. I know Aaron always tells me how much he hates tax season. And I know last time we spoke, he said he was gathering some things and throwing them together, right? So right now in real estate, when it comes to passive rental income, you have two different types of income. You got long-term income, you got short-term income. And long-term income is more, a single family home, or you're renting out to a long-term family, where short-term is more of your Airbnbs, okay? And so with those, there's a few ways that those get taxed, okay? Let me just go back here. There's a few ways that those get taxed, right? With rental income is actually treated as income. So you get taxed on every single dollar. Every dollar you earn, you pay a percentage of tax on. So Ian, what does that mean? What that means is that if you have a rental property and you're renting it out for $3,000 a month, and after all your expenses, your cash flow is $500 a month, that $500 gets included into your tax return on your income. And when it gets included, then you got to pay tax on it. The difference of that when you look at the two is if you're talking about something more about on the lines of capital gains. So when you have capital gains is a little bit different. Capital gains is a little bit more passive in a sense where it's more a appreciation in the value of an asset. And with capital gains as well, it's also something that you only technically realize when you have a disposition or you sell that asset, right? So with capital gains, it gets taxed differently. Ideally, if you're a real estate investor, you would love to push all your money towards capital gains because it means you only get taxed on half of that. But rental income, you get taxed on all of it, right? And then you have short-term income. Short-term rentals in the last few years has made a lot of noise in the news because of the fact that the city has stepped in and put a bunch of different restrictions on short-term rentals. But for the most part, they're effectively business income, and they're definitely taxed differently from capital gains, right? So, yeah. So, now, does anybody have any specific real estate tax questions that's on their mind? I see Shaz saying people should consider putting assets, not just real estate, into a holding company. Okay. And that's a really good point. People should consider putting assets and not just real estate into a holding company. There's a lot of benefits for that. And Shaz, are you somebody that you have real estate assets in a holding company? How do you pay zero taxes? That's a good question. Yeah, thanks, Shaz, for that. How do you pay zero taxes? So Aaron Charles is asking how to pay zero taxes. I'm pretty sure that you have your fair share of taxes that you pay. And he said it's possible. Or are you asking, is it possible or it is possible?
I want to hear you tell me how you make us pay zero taxes. I know it's possible, but I want you to tell me how to do it.
Oh, no worries. I'll just confirming if you said, is it possible or it's possible? No,
No, I was gonna say don't dance around it. Go straight into it.
All right, cool. So, how to pay zero taxes? So, paying zero taxes is basically just understanding how the tax system works. I mean, what you would want to do, piggybacking off of what Shaz says, is that you want to consider just moving your assets into what we call different holding companies. And what a holding company is, it's a corporation that basically, shelters your assets. So the first advantage to understand is that by moving your assets into a holding company, right? Kobe, got a question? No, okay. Moving your assets into a holding company, right? What ends up happening is you essentially are going to reduce your tax rate, right? So I'm going to show you guys something really quickly here. Taxes on passive income, rental income. Right, okay, perfect. So on this chart, it just gives you a comparison. This is just so you guys can understand the magnitude of difference in terms of what a personal tax bracket would be versus a corporate tax bracket would be, right? So under a personal tax bracket, let's say you take the same 50,000 income versus 50,000 income under a corporation, you have a massive difference in what you would be paying in taxes on this money on 50,000. Corporations tend to get preferential tax treatment. There's a bunch of reasons for that in terms of what we call like integration nature that allow corporations to get preferential tax treatment. They're done for the business of pursuing an income, creating more jobs, making it easier for you to create value and add value to an economy or municipality or whatever the case may be on a high level. So that's the reason why that happens. But if you look at that, you have a tax savings of almost $15,000 just from doing work in a corporation, okay, on a very high level. Now, the other thing is that with the corporation as a business venture, the corporation allows you to also deduct expenses, right? It allows you to deduct expenses because as you deduct expenses, you can use those expenses, especially if it's an active business, towards reducing your income to what's reasonable. So you would be paying literally like zero tax, like Aaron asked or mentioned that it's possible, all right? So let's see here. I have another chart here that goes to that a little bit more in detail. Let's go over some of these tax saving tips. So, no, we're going to go into that today. And these. So let's go into here. All right, so let's go into a conversation about corporate structuring because it seems like some of you guys are already well versed in this and how that works. I get my chat back up. There we go. I got that. Okay. Are you better off registering a corporation for each investment property or having one holdings company for all your investment properties? I mean, it depends on your strategy and how big you want to go. I personally like the angle of registering a corporation for each of your property. The reason being is, how do I let these people in? The reason being for that, and it's a good question, Jeff. The reason being for that is because of the fact that if you have all your properties under one corporation, then what happens is that they go into a class, and that class is, we call it like a CCA, like they group the assets in a certain class. And then when it comes time for you to liquidate one of those assets, there's some negative impact that can happen to the rest of the classes of the other assets in that corporation. So I prefer registering a separate property a separate corporation for each of the properties, if that answers your question.
Ian, I have a question.
Yeah, go ahead.
Wouldn't that just be a larger accounting fee if I have 5 real estate, like, yeah, if I have 5 companies, or sorry, if I have 5 companies essentially taking care of 5 different properties. At the end of the day, these are corporations, so they have to file their annual returns and their taxes. So doesn't that become more costly?
It definitely can become more costly, and that's a good question. I mean, when you have more administrative tasks, more paperwork, there is an added cost towards managing all of those properties, right? And I mean, all those corporations. So there does have some added costs. I mean, the happy balance or the happy medium is, if you really want to get into it, would be kind of just making sure you understand what type of asset class that you're dealing with. And with that particular asset class, like let's say you have a certain type of real estate property, say you have a bunch of duplexes in a certain area, having those maybe under a corporation and, grouping them as such. But then having different corporations can have advantages as well, right? So for example, when it comes to setting up your corporate structure, you have a holding company, and then that holding company holds your asset. Then you'd want to separate that holding company possibly from like a rental company or a management corp. So in other words, when you have passive income, right, there's a different tax rate that gets charged on that passive income versus when you have active business income, if you're going to be structuring correctly. Like if you have a rental property in a corporation, chances are that you're trying to keep as little income in that corporation because of the fact that you would be taxed at a higher tax rate, which would be the general tax rate. You'd want to find a way, or your accountant would want to find a way to have the rental income flow through to somewhere that's active. Let's say you have a property management company, for example, to be able to come in and now have active income and have expenses to deduct that to bring your taxes down to zero. So you do definitely need to have different corporations to pull that off. But to answer your question, yes, there definitely is added cost when you go in towards having different corporations set up. You have to find the balance that would work for you in your situation. As well as the first corporation. Let's see. For instance, I own my own company. I'm a sole director. We have 14 employees. The investments are all in corporations, including my shares. That we have management companies who manages the holding company. Exactly. As well as the first corporation. Exactly. And thanks for your contribution there, Shaz. So yeah, so then outside of that, I'm running pressed on time. So outside of that, I don't know if anybody has any other questions. Rich, you have a question?
No, I'm good. I'm taking it all in. You're going deep. The thing is, it's so informative, right? And it's good that you're at least giving people the insight in terms of how deep that we could get into with this concept, right? So right now, there's people of all different levels, in terms of where they know what they know what to do, right? But it's good to show how well versed you are in the tax area, right? And for people to understand, like in terms of structuring it, like if that's something that you're not too aware of, we have the experts that's available to you, so that you can take that move. Because I think taking each step is like hesitant. Sometimes people hesitate to continue the process, right? And it's good to see that we have someone that's so well versed. Some things may go over a few people's heads, but he knows the information, and he'll take that time to actually go over any questions with everyone as he's doing right now. So thank you, Ian. Appreciate it. Happy birthday again, man. I don't want to take you up too much of your time, but thank you, man. God bless you, brother.
Awesome. All right, thank you guys so much. I think up next is coming Collins. I think, if I'm not correct, if I'm correct. So I'm gonna pass that over to him. And thank you guys for having me. We'll definitely reconnect. All right.
Yeah. Next up, we have Jeff Agyemang up next. And then we got Collins after that. So Jeff, are you with us?
I'm here, Rich.
All right. Yeah. So we'll give you the floor, to speak with the people. You have a slide with you, or you're just more talking, right?
No slide. It's going to be more so just of a discussion. I want to be very concise and just get to the points, share some personal insights and stories with everyone, just so everyone can understand that it is possible. I know that prices are almost getting out of control at this point, but it is possible for someone that's looking to get into real estate, or that even has a little bit of real estate now, to start investing and growing their wealth. So thank you for the introduction. Thank you, Rich. Thank you, Ian, for your presentations. My name is Jeff Agyemang. I'm a real estate broker with Home Life Miracle. I've been in the real estate industry for the last 8 years, since 2014. I'm also a licensed property manager. I manage everything from co-ops to single family homes to condominium complexes to commercial complexes, 100,000 square feet and more. And yeah, I love everything that has to do with real estate, and started investing in real estate for myself around the year of 2012. So for me, again, I don't have a slide to present, but I do want to just make this a quick conversation about what you guys can do to get into real estate, and how you can see that it's possible to get in. When you are starting and thinking about real estate investments and growing your wealth for yourself and for retirement, and also for the next generation, you want to think about, first thing you want to think about is what outcome you're looking for. First off the bat, start off with the outcome and start working your way backwards, so that you can come up with a plan that's actually feasible, that you can start working towards. So that's something that I did, especially early on in my career. One thing that the WEF, that's the World Economic Forum, is telling everyone, I think it was in 2020, is that most people are going to be, and this is a quote from the president of the World Economic Forum, most people are going to own nothing, and they'll be happy with it. I agree and disagree with that point made by the president. I agree with the fact that most people will own nothing. There will be renters, and that's being shown nowadays. We're in an economy where a lot of it has to do with more of a sharing economy. You see things like Uber, Airbnb, things that are where people are instead of really owning property or owning things, they're starting to rent out things to other people who are looking to rent those out from them. And that's a very different economy than we're used to, but it is an economy that we're going towards. Where I disagree is that people are going to be happy with it. I know that for myself, when I was a renter, I wasn't very happy knowing that my landlord at any point in time could increase my rents, especially if you're in a condo that was built after 2018. Many think that the rent control rules that were put in place in 2017 will apply to condos built after 2018. That's not the case. It's rent control is about 1.2% for condos that were built prior to 2018. Anything after 2018, your landlord can almost increase your rent whatever they want. My landlord tried that when I was renting many years ago. Took our rent from $1,700 to $1,900, and we had to have a discussion on whether or not that was fair. It didn't matter to him. He wanted his money. But what we wanted for my family was to have a secure place where we could just settle down, call home, and also, you know what, instead of putting money into our landlord's pockets, let's put the money back into our pockets. Instead, that seemed like a better idea. So instead, we started looking for real estate, and we ended up buying property out in Orangeville. It's a little further out than what's in the GTA, but it's something that was doable for us, and we've benefited from it greatly. So think about the outcome that you want and what you want to accomplish for your family, what you're looking to build. Rich mentioned if you're looking to get assets for your children, think about having an asset for each child. I know that's a goal for us and myself and my wife. We want to make sure we're able to support each of our children and get a property for each of them before they turn 18, at least one. So just wanted to reference a couple of different just data points so you understand the importance of trying to get into the market now. It's really crucial that we have this conversation, and I'm glad we're having this conversation because, like I said, real estate prices are growing. There's inflation everywhere, inflation with home building costs, inflation with just cost of living, and you're going to see that we've already seen that inflation happening with different real estate assets. So think about this, and since the pandemic in 2020, the average price of all real estate, that's condos, detached semis, towns, based on data from the Toronto Real Estate Regional Real Estate Board, these properties went up about 13.5% in 2020. They started off around they finished the year around an average of 920,000. And then going into 2021, they went up another about 17 to 18%, where the average is now about $1 million. Right, that's a steep hill to climb for a lot of people. But again, it is feasible to try and get into a property and be able to leverage that into some success and some wealth for yourself. If you start off with, let's say, the lowest cost property that you can get out there, which is usually a condo unit, 1-bedroom condo unit, bachelor condo unit, downtown Toronto, somewhere in the GTA. In the 416 in 2020, the average was about $470,000. And to 2021, now that's increased to about $714,000. That's an increase of about 6.5%. Right, but that's a steady climb towards wealth, and that's something that a lot of people have started off with. I know myself and a lot of people in this discussion started off with condos, and they've been able to leverage that into getting different properties for themselves. So again, I want to touch on different stories in my own history. And I'll start off where generational wealth really started for me. That was with my mother. My mother was a single mother, single parent, and she someone that put real estate into my mind very early on without even really knowing that she was filling my mind with this information. We've moved around the GTA a lot, usually going from new build to new build to new build, and one thing she did with one of the more recent properties that we owned, that we sold around 2016, years before, she ended up putting my name on the mortgage. Now, one thing that did that was very positive was that it did open me up to lenders, and lenders seeing me as a credit-worthy individual later on when I decided to get my own property. That helped me build a lot of credit with different lenders. So that's something that I'm grateful for. And one other thing that she put into my mind, and she instilled to this day, is to save. Continue to save, even though you're seeing prices going where they are. Continue to save so that you have an idea, and then have an idea of where you want to put that money later on, ideally in real estate. For myself, I bought my first piece of real estate, I mentioned, in 2012. This was a 1-bedroom, 1-washroom condo in Toronto off Lakeshore and Parkland. A very beautiful condo in the Eau du Soleil building. Bought it around, I think it was $290,000 at that time. And about 7 years later, I ended up selling the property or assigning it to someone else for somewhere around the mid 400s. Now that property by itself is closer to $650,000, $700,000. So you see the growth rate over time just for a condo unit in Toronto. I was able to leverage that property, take the value from it, and put it into the home that we're living in now in Orangeville, and also be able to put some aside into other investments. And then with this property, we moved here in 2019, and we bought this property for roughly in the mid 500s. Last year, we were seeing properties going up in price dramatically. Homes were selling between $750,000 to $800,000 out here in Orangeville, townhomes. So one thing that we did was we were able to refinance our mortgage. And what refinance means is basically you just you're renegotiating what your previous mortgage was, getting a new mortgage rate, and also pulling equity from the home that you can use however you like. So we ended up doing that. We took some of the money. Well, first we dropped our mortgage rate down from somewhere in 3% down to 1.4. That helped us save on our monthly expenses paying into the mortgage. And then also we took some money from the property, and we decided that we were going to put some aside in investments to just grow quickly grow over time so that we can use it for other investments. We took the money also, we decided that we were going to buy other investment properties, and we actually went on almost a buying spree last year, buying about 3 different pre-construction developments. And then also we decided that we're going to renovate our basements to add extra value to the home, knowing that we're seeing real estate prices going up. And since families are having a more difficult time finding spacious properties to live in and also to rent out to use for investment income, we thought it'd be a great idea to add almost an in-law suite to our basement. And that's something that we did. And then so transitioning to this year, where we saw, when I bought the home in 2019, around the 550s, to 2021, where we saw prices going up to around the 800,000s. Just recently, we've seen townhomes selling for the millions now in Orangeville. And that's just within a year. So you can see just slowly how the property values can go up over time. You just have to start with something and then work your way towards getting the property that you want, that you've desired, and also getting the investments that you want. Now we're in a position where we can leverage all the properties that we have to buy multiple doors, and that brings in some investment income for us and my family. So that's a personal story that I wanted to just give to everybody here. One other thing that I want to say, again, I like to keep things very concise. I don't want to talk too much because I want to give our other speakers an opportunity to give their insights. We have a lot of professionals in this discussion, in this group. Myself, I'm a real estate broker, again, for 8 years. I'm also a property manager, been managing real estate for a very long time. I've managed a lot of different asset types. I understand how to maintain properties, maintain its value, and also grow its value. You have people like Aaron Charles who are on this discussion as well, real estate broker and real estate investor as well, and also real estate developer. And he can tell you his personal stories and how he's come up throughout the years and gotten to this point. Ian Nuamah, realtor, finance expert, amazing ideas when it comes to creative ways to generate financing. He's a great asset to have and a great person to have on your side. Richard Addo-Kessie, real estate broker, has been in the game longer than myself, probably a decade now, I think. And Rich knows whatever you need to know about real estate, you go to him for that. We've had a lot of discussions about investments and investing in ourselves and also in our businesses and helping clients just get into the properties that they're looking for. Bertrand, He's a renovation specialist and a real estate broker. So he can help you understand how to really just get the most value out of your property and force that appreciation so you're getting as much value as possible when you decide to liquidate your property. And then Collins, who's a mortgage specialist and a real estate investor as well. You have a lot of different professionals at your fingertips, literally a phone call or a text message away. Don't feel bad about trying to use us and utilize the insight that we have, because there's a lot of it combined between just the 6 of us. And then obviously all of our networks as well. So that's it for my time. I don't want to talk too much. I do appreciate everyone taking the time to join us today, because I think this is a conversation we need to have more often. And I think it's a conversation that's going to be beneficial for everyone in this group, and also our friends and families when you're looking to build generational wealth and get started in real estate so that you can build generational wealth. So thank you, everyone. I'll give the mic back to Rich to get going.
Yes, that was amazing. Thank you very much, Jeff. I appreciate you and all the insight you're given. You know, one thing that really stood out amongst everything else, but when you said that, you know, get something and, you know, you could get closer to what your dream home is, right? That's so important, right? Because there's so many times when there's properties that may be far, you know, or they may not be in the best location or the best size or anything like that. And, you know, I'm sure yourself as well as me have clients that are like, no, Rich, that's too far. I'm not going to go there, you know? And that's why, you know, like, yeah, just go get the place. And look what happened with you. You got the place, and then 2 years later, it was like $300,000 more. You could take that money and then you could go closer to wherever it is that you want to go. You know, so thank you for, you know, emphasizing that point, because that's something that happens very common.
Anytime, Rich. I appreciate conversation like this. This is fantastic.
Yes, yes, for sure. Thank you. We have a few questions inside the chat box too. So anyone that's in there and you see anything that you could answer any questions to, you know, then, you know, just answer the questions away, because that's what we're looking to do here. We're looking to come together as a collaborative and get all the information out, because, you know, all the questions that are being asked, people are actually retaining that information. You know, all the speakers, listen to what they're saying. You know, what they're saying, they're giving you experiences. Like Jeff just showed you the experience of his timeline from when he was young, from when his mom was actually showing what real estate, and then getting a property, and then the property value increased and allowed him to get another bigger property for his family. And then last year they said they snapped and they got 3 properties, you know, and it's all it starts with one. It starts with one property, you know. So yes, Collins is ready to go. No, Collins, you're next. You're next. No, please. Yes, a lot of inspiration. Jeff, says Atto. You know, amazing presentation, Jeff, says Freema. Right, and you know, and yes, Kwasi, you can get the contacts, you know, on here. If you registered, you're going to get an email after as well, you know, from the contacts also, right? And please fill this form. You know, I'm posting a form in again, you know, within the chat. You know, if you guys could actually go through that form, fill it, answer those questions in that form, right? It gives you a good idea in terms of where you currently are in real estate and then where you want to go, so we can help assist you with that as well. So our next speaker is Collins, Boakye-Yiadom. Collins, are you here with us? Collins, I know you just sent the message, so I know you're here with us. Maybe Collins is trying to set up his mic.
I'm here.
Okay, there we go. Welcome, sir.
Thank you. It's been a great presentation so far.
Can we see you, man? You're a speaker, man. We got to see you, man.
No, you know what? My camera, for whatever reason, is not working. So that's what I was trying to fix as well too. But
all right, we'll look at the picture for now.
You guys see my lovely picture. You can see my lovely picture for now. Rich, can you do me a favor and give me access to share my screen? All right. Can everybody see this?
Yep, we could see it.
Okay, perfect. Well, I don't want to take up too much time. Once again, my name is Collins. I know there's a lot of information when it comes to financing. There's tons and tons of information. Like everybody has said before, everybody here has a wealth of information. So I will touch on, you know, high level things, and then definitely we can reach out if there is more questions, or we can attend to some questions at the end of the presentation. So I'm going to do a quick introduction. We're going to talk about how to actually get a mortgage and the 5 C's of credit. We're going to talk about creative ways to purchase your first home through resale, pre-construction, and group economics. And then we're going to go over 2 case studies as well that I feel like will be very pertinent to this group. So there we go. Okay, so about me, I'm a family man, married with 3 boys, so it does get a little noisy in my house. But I, as all the other gentlemen have mentioned, we do believe in generational wealth. So why we do what we do is for the children of the future, right? I am also a Dreammaker representative, so I belong to an asset management company called Dreammaker, located in the GTA. For those, it is a Black-owned real estate company. We have multiple divisions. For those who are in the Toronto area, if you're familiar with the Yorkdale Mall, the largest luxury mall in Canada, there is a mid-rise condo right across from the Yorkdale Mall. That is actually Black-owned, built, developed. So very, very important in terms of representation. So whenever you drive by it, just know that it's somebody from the community that was able to plant some seeds, acquire the land, and actually build that property, right? So I am a part of that group. As a member of that group, I also teach real estate as well, and then also have an opportunity to talk about different ways that the community can come together and build generational wealth. I'm also a real estate investor personally, with my own portfolio, and of course, I'm a licensed mortgage agent with Matrix Mortgage Global, and then I also am a real estate investing coach, teaching 9-to-5ers how to actively and passively invest in real estate. Okay, so let's start. So what is the process, right? So we talk about mortgages, we've been talking a lot about real estate, but we're gonna drill it down to the very basic principles of real estate. Is you can't have real estate without the financing, right? So if you look on the right-hand side here, we talk about the 5 C's of credit. Again, very quickly, we talk about capacity, capital, collateral, character, and conditions. So number 1, we talk about capacity, right? So oftentimes you will hear in the news or in the media, sometimes you'll hear something about a stress test, or you'll hear about debt to income ratio. The news will often talk about how much debt the average Canadian is carrying. All of that ties into the mortgage process as well too, amongst other economic factors. But of course, if you think about it on a very basic perspective, if you were to come to me and want to borrow money from me, I would look at basically, hey, like how much debt do you have? How much income are you making? And how much money do you already owe? So if you're coming to me asking me for $100, but you already owe Richard $10,000 and you only make $500, well, then I know that your ability to repay that debt once I've given it to you, because of your debt to income ratio, is very low. So I may never, if I give you that money, you may never have the ability to comfortably make the payments to pay me the interest on the loan that I've given to you. So again, that all comes down to your debt to income ratio. So you think of it as the higher the income is, the better, the lower the expenses also, right? So you can increase the ratios or better the ratios by either increasing your income or decreasing your expenses. Sometimes we have to do both. There's so many different ways that we can tackle it. But at the end of the day, if you're looking to purchase real estate or get into the market, you want to try and keep your debt as low as possible, so that it betters your opportunity to basically get your ratios in line. And then there are tons of lenders out there, that brokers like myself, I see the Abby's on the call, that we have access to, that we can now also look and see what's the best lender for you and what products we have that can be able to suit your specific situation, right? The next one is capital, right? So here it indicates the borrower's level of seriousness. So you can think of this as basically it's your down payment, right? How much down payment are you bringing? Here in Canada, we do have a minimum down payment of 5% of the purchase price, up to $500,000. And then it scales from there. I believe it's 10% on the difference. So assuming you're going to buy a condo or house or any property that's up to $500,000, your minimum down payment is 5%. Now, that being said, you are bringing something to the table. A note: there are many ways to get into real estate, and there are some cases where you can actually get into real estate without necessarily putting all the money in yourself. Again, that's a much more advanced discussion for today, but maybe perhaps we can host another session on that in the future for those who are interested. But for all intents and purposes, for those who are just now starting out, you need to have some kind of skin in the game, which is basically your down payment, right? Which can range between 5% all the way up to as much as you actually want to put down. We talked about collateral, right? So collateral is the assurance that if the borrower defaults on the loan, the lender can repossess the collateral. So essentially, this is kind of like the actual property itself, right? What is the bank lending on? Is the bank lending you money on a property that isn't very well taken care of? Is going to give them a lot of problems? Is the roof leaking? Are there, is there mold? Is there pest infestation? The major banks really want to make sure that if I'm lending you money, I'm lending you money on an asset that is good. Richie talked about this earlier, where the banks want to lend you money, but they want to lend you money on good assets, good quality assets, right? So this is where the bank will do their assessment to make sure that what they're lending you on, or what they're lending you is on an asset that is good, and one that they can liquidate in the event that you decide to take off and disappear to Mexico. They can now sell that asset to now recoup the mortgage that they've now given to you, right? The next one is character. Character is basically your credit history. So do you have a history of paying your bills on time? What is your credit score? A lot of people, there's countless amount of people that I will speak to that they're very afraid, especially in our community, they're very afraid of checking their credit score. And I say, if you don't know the score, there's no way for you to put in actionable steps to actually correct it, if it even needs correcting. In some cases, some people are so nervous to even check because they feel like it's bad, when actuality it's probably not that bad, right? So I encourage everybody to do themselves a favor, make sure they know where they stand with credit, whether you're buying a house or not. Even if it's getting a loan, make sure you check your credit. A lot of times, lenders or even creditors will actually make mistakes on your credit profile, right? One that's known for that is Rogers. So if anybody has a Rogers bill or has left Rogers, I personally have a love-hate relationship with Rogers, but you be very careful, because Rogers will usually, they like to make mistakes. So if you paid off your phone contract and you've left Rogers and you've gone to Bell, let's say, they'll now say, oh yeah, you actually didn't pay. And then they'll report to the credit agency that you missed a payment, when in actuality, you made that payment in full on time. Then you have to go back to the credit reporting agencies to make that adjustment so that it reflects correctly on your credit profile. Again, you don't want to be held up on a mortgage because Rogers made a mistake, a legitimate mistake on your profile. So something that when you're getting ready to actually get into home ownership, you definitely want to run your credit check, either Equifax or TransUnion. Those are the two major credit bureaus in Canada. You can check them and then make sure that everything that's reporting is correct, right? And then the final C is conditions, right? So these are basically the interest rates and the amount of principal that basically you'll be given. Again, this kind of ties into the stress test. The stress test is basically measuring your ability to handle a higher interest rate and higher debt. And essentially, it just measures your ability to be able to repay the debt and not default, right? The last thing they want is for you to now walk away, and for everybody to walk away from their mortgages. That would give a lot of problems for the economy, obviously, because nobody would pay their bills. Nobody pays their bills. The banks don't make money. Banks don't make money. They have to lay off employees, et cetera, et cetera, et cetera, right? So it's a huge ripple effect, right? So these are the 5 C's of credit based on lenders. The majority of lenders, they look at all all five things. So again, capacity, capital, collateral, character, and conditions. So now once you've figured out those 5 things and you're in a good spot there, the first step is to get a mortgage pre-approval. You need to know how much you can actually afford. There's no sense in looking for a $700,000 house if you're only approved for $400,000 mortgage, right? It's a waste of everybody's time. And also all the agents will tell you, once you have that pre-approval in hand, you can now make more aggressive offers. You can now be more quick to act in the market, right? And that's what you want, especially in this competitive market that we have now. So number one, go to your bank, go to a mortgage broker like myself or whoever to actually get that mortgage pre-approval and know how much you qualify for. Number two is to build your power team. You definitely want to be able to have the power team that has your mortgage agent, your mortgage agent, your realtor, your lawyer. These are people that you want to have in your power team so that your power team can actually basically help you to now make this purchase successful, right? And they can advise you in different areas all amongst the real estate process. And then the third thing is once you have your mortgage pre-approval, you have your power team, you start searching for a property, you put it in an offer, you close on the property. And then step number 4 is to enjoy, have a housewarming party, invite all of us here, we celebrate your success because you're one step closer to building generational wealth through real estate. So ways to purchase your first home. It's mainly split up into 2 areas. Either you're buying a resale property. So again, coming to terms, you may hear resale. Resale is essentially buying something that is an existing property from a previous owner. The funds need to be in the account now, right? You need to have those funds available, your down payment and your closing costs available now. Again, we talked about 5% down payment plus your closing costs. And then you're moving in typically between 45 to 60 days, sometimes earlier, sometimes longer. Generally, you'll find all the listings listed on the multiple listing service, so MLS or realtor.ca. Again, when you're using a realtor, they will have access to this and they will be able to see all the information there. The second category is pre-construction. So essentially you're purchasing based off a new build from a developer. You're essentially signing an agreement with a developer, with a builder to now build a project for you in the future. In exchange, you're making deposits. Deposits are typically spread out over time. You don't need all of the money right now. In exchange, you don't need all of the money right now, but there will be periodic deposit periods where you need to make a payment to the builder towards the project. Each project can take between 1 to 4 years, 4 years plus. And again, the down payments range between 5 and 20%. Typically, you don't see 5% down payment from builders anymore. I think there's only one builder that really allows for 5% down payment. That's Daniel's First Home. Great builder, huge builder, great reputation, but because they only offer 5%, they're pretty much the only developer that offers 5% down payment. They get a huge backlog list of worksheets of people interested in their properties because it doesn't require as much capital up front. Okay, so now let's talk about strategy. So specifically strategies for the community. So I was thinking about this, and one of the things, again, that Richie mentioned is a lot of, for those who actually own homes or our parents own homes, one of the biggest ways to actually enter into the market or to build wealth is through multifamily real estate. So multifamily can be a couple of things. It can be as simple as renting out a room in a house or multiple rooms in a house. You can think of, let's say, student housing, or even just renting out a room in your house to a cousin or a family friend, or maybe even somebody that you don't know, right? You look at an income suite. Income suites, you typically look at basement apartments. So you have somebody upstairs, you're living upstairs, and you can rent out downstairs. You can talk about ADUs. So ADUs are accessory dwelling unit. So these are typically, you'll hear talks now about laneway houses or garden suites. So these are properties where you have a main house, and then in the backyard or at the back of the building of the main house, you'll have a smaller house that can house somebody else, right? So this is kind of multi-generational housing as well. And then there's actually multifamily. So you think about small apartment buildings or even large apartment buildings, anything over 4 units is considered commercial residential multifamily. Anything under 4 units is considered residential, but it's still multifamily, right? And the reason why I touch on multifamily is because you're able to now turn your liability of your house and make it an asset by adding multiple units where you can, where possible, right? So for example, if you have a upstairs, you're living upstairs and you have a basement that's unfinished, it's better to actually renovate the basement, put a basement apartment in there, and at the very least, you now have somebody that's in the basement that's helping you to now pay off your, pay down your debts and pay off your house quicker, or even just improve the cash flow. And then the cash flow that you get from the basement apartment, you can now use that to now reinvest into other real estate, use it to reinvest into your child's education, use it to, you know, open a business. But this is the ground base level fundamentals of how you actually build generational wealth through real estate, right? Turning that asset or turning that liability into an asset, right? And again, we talked about short-term rentals. So again, you know, if you're in a different market, you can now take a property, rent it out short-term, and basically rent it on an Airbnb. If you do the math, and basically if you have somebody renting out your place for, let's say, I don't know, $100 a night times 30 nights, that's $3,000 a month that you could have if you rented it out for $100 a month or $100 a night every night before your expenses, right? Before your cleaning expenses. But $3,000 a month could be significantly more income than whereas if you just rented it to somebody long-term in that market. Maybe you'd only get $1,500 a month, but have one tenant in there. So there's pros and cons to both. But again, it's just another way of income, of thinking of income, of generating income and building wealth, right? So you can see here, this diagram here kind of gives you a brief overview of the different types of multifamily situations. So you have secondary suite upstairs, and then you could be living downstairs or vice versa. You can have the kind of the basement apartment thing here. This is an example of a garden suite, et cetera, right? So yeah, so strategy number 2 is pre-construction. So again, we talked about how pre-construction is basically building, is basically putting down a deposit in exchange for a contract with a developer to build a project over time. I'm sure everybody has seen the multiple dozens, probably even hundreds of cranes around the Greater Toronto area. Toronto, I don't have the statistic up in this presentation, but Toronto actually leads North America with the most cranes up in terms of development in all of North America. So we have the most development happening in all of North America right now in Toronto. And the reason for that is because we have such high immigration. We have so many people coming into the country. So we need houses. We need to build vertically. The only way, the most efficient way to build and house people is to build vertically because it takes up less land area, right? So yeah, so we talked about this. You'll have a purchase and sale agreement, which is basically a contract that you'll sign, and then that will outline all the terms and agreements there. So this is an example of one of the projects that we were offering. So over here, so this is an example of a floor plan. So you can see here, this unit is a 1-bedroom, I believe, 1+ den. So you can see here, you have the square footage, and then the layout here. So this is basically the schematic that you'll see. You'll be able to pick, and then from there, they'll tell you the price, et cetera, and then the deposit structure, right? Again, pre-construction can be high-rise, low-rise, detached houses, semi-detached houses, townhouses. But again, based on where you are in the city, you most likely will see a lot more condominiums, right, being built. So here's a case study on a project that we had. This is actually at Weston and Shepherd, if I'm not mistaken, Weston and Shepherd. Again, got in around 2018, I believe, with this phase. And with this phase now, a lot of people were talking, okay, well, this area is not so great, et cetera, et cetera. But we looked at kind of the fundamentals of the area and said, you know, the spread between townhouses, condo townhouses, and detached properties were selling above $1 million easily at the time. So you're able to now get a product at $450,000. The down payment was about $45,000, which means that your mortgage balance would have been $405,000. So at $405,000, this is typically what you would bring a mortgage for when the developer tells you that the property is now finished and ready to basically be moved in. There's a couple of steps in between, but for argument's sake, for right now, this is typically when you go to a major bank, they would ask you, they would only finance the difference between what you've given the developer, which is $45,000, and what you owe, which is $450,000. So the difference, the mortgage balance, the difference is $405,000, right? So you get a mortgage for $405,000. Now, with creative financing, there's products out there that we have access to that will basically give you 100% financing. So instead of, so now fast forward 2020, the property is finished. The builder tells you, hey, we're going to be completing this project we're going to be completing it in 30 days, 45 days. In 45 days, you need to bring the $405,000 in the form of a mortgage or cash, right? Most people obviously choose a mortgage, right? So, but now in 2020, this property is now worth $575,000. So you bought it in 2018 for $450, but now it's worth $575. So what we're able to do is we're able to go to this other lender, a Schedule A lender, and now able to give you a mortgage based on 80% of this 575 value, not to exceed the purchase price. So if you now go on your phone, go on your calculator, and do 575,000 times 80%, so times 0.8, that gives you $460,000. So this lender will now lend you based on 575, which will give you $460,000. But we cannot exceed the purchase price. So our purchase price is $450,000, which means they will register a new mortgage at $450,000. So now this $45,000 that we've given as a down payment, we now get that back on closing. So now the $45,000 investment that you made, you're now getting that back, and you've essentially now gotten 100% financing. So some of our students, what they do is they now partner together. They now take the money from their parents. They maybe band together with somebody else, and then they're able to now borrow that $45,000. But then at the end, because the property has increased significantly, they're basically able to get that $45,000 back on closing and still be able to keep the property, right? So again, it's just another way to build equity, to build wealth, where you're able to now leverage and still be able to access the property and own the property. And in this case, you still own the property and you're able to get your initial capital back, all right? All right, so strategy number 3 when it comes to group economics. So I just touched on this a little bit. So using home equity from friends and family, that's definitely source number 1, and we can talk about that in the next slide in terms of equity. I see the chat is going. I'm just going to power through this and then I'll address the questions at the end. So I'm not ignoring you. I know there's a lot of information, so I will come back to the questions. So home equity. So now when we talk about equity, you can look at this chart at the bottom here, this graph at the bottom here. So this gray part is your existing mortgage. The whole house basically is the total value of the house. And the lender will now, or the banks will now give you a certain percentage of this, which is typically about 80% of the value of the property. So now if this line is 80% of the total value of the property, minus whatever you owe is the gray part, that means that this middle part here is the equity that you're able to now access. So how we access that equity could be through a refinance, which basically means pulling out the equity, restructuring the loan, or we can do it through a line of credit. We can do it through a second mortgage. There's various ways we can access this equity, right? But at the end of the day, the goal is to now access this equity to now reinvest into other assets that make us money, or to even now pay off debt even, right? To free up cash flow. And then once we free up cash flow, we can now use that cash flow to now reinvest into another asset class or into more real estate that makes us money, right? But again, once you have that equity, you can now give a borrowed down payment. So for those who already own property or who have children that are adult children, you can now use that equity to now gift that down payment to, you can now gift the down payment to your adult children so they can now go on and buy a property for themselves. You can lend that equity out in private lending. So once your mortgage interest rate is typically less than 3%, but then you can now lend that money privately and get returns of 6, 10, 12, 14% in some cases through private lending, right? So you can lend to other developers, other builders, other institutions. And then I'm sure Aaron's going to talk a little bit about development investing and having shares basically and getting it on the ground level on some of the investment properties, or actually investing in the development itself rather than just a unit in the development, right? So here's a perfect case study. So this is one of my clients from last year, 2 years ago, I believe, where basically they had a current mortgage with Scotiabank. It's $295,000. It was coming up for renewal. They're currently paying $1,446 per month. Their property was appraised, that's even a typo. The property was appraised at $1.2 million at that time. And essentially, the daughter had good income. So we talk about the 5 C's of credit. She had good income, good credit, but she had no capital. She had no down payment, right? So when we spoke, I said, yes, you can actually take this money from your parents' property. So we were able to refinance her parents' property. We got her a great mortgage rate, interest rate, and basically they were able to now refinance the property. So their mortgage balance increased, went from $295 to $375, but their monthly payment actually came down. So they were able to gift their daughter $80,000 tax-free, but their monthly mortgage payment was $20 less. So for $20 less per month, they were able to gift their daughter $80,000. So as a parent, it basically is free money. It doesn't cost you anything because you are going to pay the $1,446 anyways. So now you're paying $1,420 and your daughter has $80,000, which she can now use to now go and buy her own place. So her options were she was exploring looking at buying a resale property using the $80,000 and some of the savings that she had, or investing into a pre-construction property and making periodic payments of a down payment up to $80,000, for which in the future, for this condo, in either 3-4 years, she can now choose to now live in that condo or even and get a mortgage, or at that point, just sell the condo, or going back to the 100% financing, she might be able to now utilize a 100% financing method. And now she's going to own this condo and get her $80,000 back. So if at that point her parents say, hey, you got the $80,000 back, give us back the $80,000, well, then the parents can now go make a lump sum payment on the $80,000 on their mortgage that they owe. So their daughter was able to get a place and live in it, build her own equity, and then she was able to basically give back the money if she really wanted to. I'm sure in this case, now that she has $80,000, she's probably going to go buy a nice car or something. But I believe she actually went and her plan is to now take that money that she's going to get back in the future to now reinvest into another pre-construction property, right? So you can quickly see how real estate can now build that generational wealth, right? And again, it's not that difficult. So we can take it a step further in my next situation here. So now this is very, very typical, especially I'm Ghanaian. So if I'm talking to all my aunties and uncles that many years ago they purchased in Brampton. So they typically purchased for between $250,000 to $350,000 back in 2011. Today, their house is appraised at easy, and that 1.2 is very conservative. Some of these properties, recently, some of my clients, their properties are being appraised or valued at over $1.3, $1.4 million, right? So now in this case, the property appraised at $1.2 million. They paid down the mortgage. So their mortgage balance over the last 10 or so years, their mortgage balance is probably closer to $150,000, right? So now they can now go to the bank, get a mortgage of a new mortgage balance of $500,000, and they'll have $400,000 cash available. So after they now refinance this mortgage, they'll have a new mortgage balance of $500,000. So instead of owing $150,000, they will owe $500,000. But their monthly payment based on 1.9% variable rate is just over $1,800 per month, right? For the new mortgage. Now they have $400,000, right? Yes, great. So now the question is, what do you do with the $400,000? So from the $400,000, one of the plans that we do is for those who have, again, we talked about the multifamily strategy, right? So you can now take $60,000 of the $400,000 and create a basement apartment, do a basement renovation. Bert's gonna come on there. He can basically talk, come on soon. He can talk about strategic basement renovations or renovations in general. So you can take that $60,000, renovate your basement, turn it into a legal basement apartment. For those who live in Brampton or pretty much anywhere in the GTA, no property basement apartment right now is less than $1,000 per month. Basement apartment, 1 bedroom. Like it's impossible to find, basically. Right? So now you were comfortable now paying the $1,800, you're living upstairs, but now you're getting $1,000 per month cash flow from renting out your basement. All right. So that's $60,000 spoken for. You can now take another $150,000 to now go in and buy a resale property. And that $150,000 can cover your down payment and closing costs. Depending on the market that you're in, you can get anywhere between, $300 to $700. I saw one today that was $1,000 per month cash flow out in Peterborough, right? So now you're getting cash flow from there. Again, your money is working for you. So now you'll have 2 tenants, most likely 2 tenants renting out this property here. You're getting cash flow, and not only are they paying down your mortgage, but you're also building equity over here as well. Then you can take another $150,000 over here and invest that into a pre-construction property. Again, pre-construction property, the property is not going to be finished until the future. Maybe it's a condo. In this case, it's a condo, so maybe 3-4 years down the line. Then at that point, you can now choose to sell that property or assign it or sell it basically before you actually take possession for profit. And then the third option here, or the fourth option here, sorry, is the remaining $40,000 you have here. You can now choose to invest it into stocks, asset classes, invest in a business, whatever you want to do here, you can actually choose to invest that. So because we believe in, again, building that generational wealth and diversifying as much as possible, right? So that is basically the explanation there. We've gone through a couple situations here in terms of how you can build wealth. I know it's a lot of information, but these are the quick strategies that I believe can help the community immediately to build wealth. And again, if anybody wants to touch on anything specific, I can definitely do that and open it up to questions now. So thank you guys for your time.
Wow, thank you very much, Collins. That was amazing. You gave a lot of information, and that's, guys, we want to continue to do this. If you haven't yet already, please fill out the form. I just put it in the chat area, and in the form it asks you, how often would you want these kind of seminars? Weekly, monthly, yearly, right? Because if it's up to us, we'll do them daily, right? Because all of us wealth creators that are on here, this is the information that we're talking about all the time, that we're connecting on, and this is the conversations we should be having, not what's on the news. That's not interesting. The conversations we need to be having is how are we setting up the next generations. So thank you very much, Collins. Appreciate that. Next up we have Mr. Bertrand Moy. Collins, if you don't mind, your screen's still sharing. All right, Mr. Bertrand Moy, are you here with us? Can you guys hear me? I see if Mr. Bert
Yeah,
is
you're
here.
good. You're good.
Okay, is Bert, are you here with us still? Bert's a busy guy, man. He's out there making all these listings and because he's helping people, you know, build generational wealth, you know, so he's working hard. You know, he may have signed off. If he has, okay. So yeah, I don't think he's on here. If he comes back on, we'll give him some time to speak, right? But right now, again, guys, please look at the form, right? Fill out the investors form, right? To ensure that this does not remain only a real estate discussion, please complete the form, all right? And, you know, have us properly analyze your situation, right? To determine the best real estate strategy for you. You know, I know right now all these ideas are coming, so you may have interest, you know, and that's all you need, interest. All you need is interest. Please fill out the form, you know, and once you fill out the form, we're here to work with you, you know, and on top of that, talk about working with people. You know, I want to bring on our special guest today because, you know, someone that has built to where they're developing properties and, you know, the properties that they have, they're going and sharing it with, you know, the Black community, letting us get a seat at the table, giving us an opportunity to get the seat at the table. It's a big deal, you know, being a real estate broker, you know, just knowing and connecting with developers, you know, they give you, only if they like you, they'll give you allocation for us to sell, you know, and I'm so grateful that, you know, Aaron is, you know, he actually offered to be a part of this, you know, webinar. And that's what we need, more offerings, more service, you know, connecting with the community because, you know, just like he's building these properties, it could be someone on this platform right now. That could be your first home, right? Because of the opportunities that he's opening up. So Aaron, I want you to take the floor. Thank you so much for joining us.
Hello, Richard. How are you doing? Am I on the camera? Change my video.
Yeah, you're there. We got you on the camera.
Give me 1 second. My view is a little. Okay, perfect. Richard, thank you for having me. Collins, thank you for getting me involved. I saw you guys promoting online. And I'm like, these are some young Black professionals here. I need to tap in and see what these guys are all about. So I hit you guys up and I'm glad you guys welcome me with open arms. I just feel like now is the time for us to connect as a group of individuals, young professionals in the city, and to share our knowledge and give back to our community in one way or the other. You know, so congratulations to you guys. Great presentation. I was here since 7 o'clock taking it in. You guys are teaching great things. Every single strategy you guys mentioned on this presentation are things that I've applied in the past, things that I apply to this day. And I believe majority of your clients or followers here, by the way, I'm very impressed. 71 people are still here and it's been almost 2 hours. In my masterclass, it's an hour and they're gone. So that's you guys have a strong group here. But I've been practicing these strategies for years and years, and you know it's gotten me to where I am today. For those that don't know me, my name is Aaron Charles. I'm a licensed realtor. I've been in real estate for the last 15 years now. I'm also a real estate developer. I've been developing real estate for the last 3 years. I'll just give you guys a quick journey. I think when I came on, I was kind of like, you know, what should I share? How should I start? What should I get into? And I feel based on the information that you guys gave today, I kind of want to maybe wrap everything up and put it into a bow just to show everybody that what you guys are saying is possible. Everything all the strategies that you guys have mentioned, I've applied and I can put into context and how I started. So I started back in 2009. That's when I bought my first property out in Hamilton. Didn't know anything about real estate. I didn't have presentations, seminars, Zooms, IG, anything to go off of. I just knew based off a simple Google check that 90% of the millionaires came from the real estate industry. And I always knew I had an entrepreneurial spirit in me. At that time, I had a party and promotion business where we're renting out clubs downtown, and we were inviting our circle of friends, and we're bringing 300 to 500 people to the club. So, I said to myself, you know what? I'm 21 right now. I want to start experience this club business thing, but I don't want to spend money to go to the club. So I invited all my friends to a club that I rented out, and I was making $3,000, $4,000, $5,000 a weekend partying with my friends. And that was ultimately the money that I kind of used to get into real estate. Not a lot of people know that story about me. I kind of keep that one quiet, but yeah, I used to be a club promoter. Saved up about $15,000 at that age, and I knew I had to do something with it. I was already thinking about wealth. I was already thinking about, okay, I can't let this money slip through my hands. What can I do with it? At that time, I was also working night shift at the TTC. I also knew I wanted to get out of that job as well, but I also knew everything takes time and proper planning prevents poor performance. So I knew I had to put a plan in place. A lot of us want to get into that entrepreneurial spirit and jump right in, but take it from me, you have to put a plan in place, and you have to use your job to leverage that income that you're making, that's secured income, to then build your, like Collins was saying before, you have to attract the banks to lend to you and leverage and build that portfolio first, and then you can step out. So through my journey, I fast tracked and I said, you know what? I want to get into real estate. A couple of my friends were in university at that time, UFT, and they were taking a commerce course. And one of their courses was about real estate. They had to go out there and analyze and look at deals just for a project's sake. So I happened to tag along with them. I had this capital, but I didn't know what to do. They were doing a real estate exercise. So I went out to Hamilton with them by fluke. I happened to be around them that day, and they were looking at properties, analyzing properties. I was asking questions, and then I start to realize I'm part of this project, but I'm actually just a volunteer. But I actually had the money to buy the real estate. So I got inspired, and I said, you know what? Having a competitive spirit that I have, one of my friends actually took his OSAP money and bought a real estate property. I'm like, oh shoot, if he's doing it, I don't want to be in last place. So I jumped in and I bought real estate. So that's the power of, first of all, hanging around with people that have ambition and they know what they want for themselves, and something like this, a network, right? You guys are kind of somewhat competing with each other, collaborating with each other, and hopefully making each other better in the whole process. And I was doing that with my group of friends. So I saw my friend buy a property in Hamilton just based off a simple project. And that's pretty much got me to where I am today. But I made the leap of faith as well and said, I want one too. And I bought a triplex in Hamilton at that time for $140,000. For a triplex, I was cash flowing about $700 a month. So my property was paying for itself. So when I got a taste of that, I was like, oh, wow, like I have a property that's paying for itself, plus giving me $700 a month in my pocket. Well, you know what happens from there. I got addicted to the process, and I wanted to find out ways to buy more real estate. But the hardest thing at that time was finding mentors or finding people that would actually show you. First of all, there wasn't no one of color that I can identify with that could help me and teach me. So I started to go on the weekends to hotel lobbies, or what are they? Those rooms, those conference rooms, and attend so many real estate seminars, Rich Dad, Poor Dad, soaked in the information. But I always felt that information wasn't true or genuine, or they're always holding back the real information to get you to sign up to these courses. And I didn't have the extra money to be paying $5,000, $7,000 for courses. So I had to just figure it out. But I went on Kijiji one day and I found a property that I liked. And the gentleman who was purchasing the property, he happened to own 100 properties in Hamilton. And I got to know him a bit, and I told him my story. And he's like, you know what? I wish my kids at this age, I was 21 at the time, were thinking about buying real estate. So he kind of took me under his wing, showed me all these strategies that Collins and all these guys are talking about today. And I kind of got an opportunity to kind of work those strategies. Fast track a bit, age 25, I was on my 10th property at that time. I had multifamily properties, 7plexes, triplexes, 4plexes, single family homes, condos, pre-constructions. So I had a bit of everything. I was going a little bit crazy. But at that time, the bank was lending to me because I had good assets that were cash flowing. I had income from my job. My credit was good. So I was like, a unicorn to them, and they were just feeding me these mortgages. But what I got to learn really quickly in real estate is depending on the asset that you get, you can always keep attracting the banks to continue to lend to you for the simple fact that if your property spit out cash flow, the banks no longer look at you to qualify. They look at the property and qualify the property. So once a property can take care of itself, that property is qualifying on its own, right? And that's when you put in a corporation and you start running it as a business. The other thing that I start to realize as well too is once you own 2 or more properties, you're now considered a business, even if it's in your personal name, and you get to write down your taxes. And then I start to write down even my income tax, and I was getting back $10,000, $15,000, $20,000 a year sometimes in tax return. And I was taking that $20,000 to buy more real estate every year. So every year I was getting my tax return, I was buying another property on top of applying strategies that I was learning in the marketplace, like the Burr method, getting VTBs, getting cashback deals from sellers. So really applying and going really aggressive. So when I started acquiring real estate, I started to get a little bit more interested in different areas of the market. And one of those areas was renovations. So I bought my first renovation property in Hamilton, paid $100,000, turned it into a 4-plex, ended up selling it for $420,000 a year later. I learned a lot from that project. And then I bought another property in Stony Creek. It was a bungalow. I actually did a kind of a special deal there, but I ended up purchasing the property, renovating it, flipping it into my corporation, and then having my corporation operated for a couple of years as a rent to own. The individual ended up defaulting on the rent to own, and then I was able to sell it and flip it for more profit. So I ended up doing a double flip to myself, which was kind of by fluke, but I was just being creative and understanding the different strategies. I didn't panic and just continued moving along. So everything sounds good, but the whole journey isn't always as smooth as the storyteller makes it seem. So I like to be very transparent. A lot of you guys know I'm a very vocal person. If I give you the good, I'm gonna give you the bad as well too. So some of the mistakes that I made starting off was I wasn't patient enough, and that comes from the lack of visibility in our community of people who are in real estate and actually seeing how you should treat real estate. A lot of us treat real estate as a profit center, which is good, but we always short ourselves in our community. We sell out a little bit too early. And that being said, if you look at other communities, they hold real estate for generations and generations and generations. And that's where the true value of real estate is realized. Being a young Black kid coming from at-risk community, the most my parents has ever given me was the basic necessities, which I always thank them for, but they never give me anything. I never got a loan from my parents, never got any type of help. So, seeing your first 50, 80, 100 grand at that age, at 21, 22, you think it's money, and it is money. And I don't want to sound ungrateful, but in the grand scheme of things, some of these properties I was purchasing for 100,000, selling for 200,000, 300,000. When I look back on MLS now, they're selling for 1.4, 1.5 million, right? And that's just holding it for 10 years. So I shorted myself on certain transactions if I was a little bit more patient. And then also, I wasn't patient because I was scaling so fast. I always had to sell properties to get into other properties or get into different ventures. But if I was to do it all over again, I was to talk to my younger self, I would say hold a little bit longer. But that being said, I was able to kind of fast track and get to where I am in the development space because I was able to move through different sections of real estate. But, for the masses, most people don't want to take on real estate development. And I don't blame you. It's one of the hardest, most challenging things I've ever been a part of. It takes the most out of you in terms of sacrifice, very capital intensive, very political driven, a lot of red tapes that you have to go through. You have to deal with the city and all that stuff. So, I always had from a young age the ambition to want to be a landlord and a real estate developer. If you asked me at the age of 15, 16, that was the answer that I would give you. And I took it very serious. So I went through all the cycles of real estate. I started off my real estate career. I got my license after owning 10 properties. I got my real estate license because I wanted to start selling my own properties. I wanted to be my own client. So I joined Dreammaker Realty. That's where I got my start. Chose Dreammaker Realty because they were Black led. The owner had great ambitions, done great things. They've they were the example that I was looking for to kind of mirror and build my success off of. So I was a dream maker for 10 plus years, and that exposed me to pre-construction investing as well. So I went from being in the ground, buying multifamily, dealing with tenants, being a landlord, to then finding the strategy of pre-construction. I didn't understand it at first, and then it took me a while, but then I got into it and I started to realize, man, I can really scale and buy properties because I don't have to get a mortgage right away. The property is not going to be ready for 2, 3, 4 years. And by the time I get that property, the property is going to have equity, and I'm going to have the option to have different exit strategies if I want to sell it on an assignment, or if I want to close on it and then rent it out and pull some capital out and refinance. So I got into pre-construction as well, sold some buildings in Hamilton, came back into Toronto and started to really build my portfolio through pre-construction investing. So the market was really it was really a buyer's market at that time. We were buying Queen West, King West, Liberty Village, areas that, are now booming, Junction. But at that time, it was very hard to convince people to buy condos. Everyone was stuck in I need a house, I need land. So, condos were going for 199,000, 150,000, 200,000, 250. Deposits were, like Collins was mentioning before, 5% down, getting cash racks from the developers. A lot of incentives were being given out at that time. So for those that were able to take advantage of, the economy and people's fears at the time, made a lot of money, because those properties now are 800, 900, $1 million, 650, 750. So a lot of people made some good coin there. So pre-construction did me very well. Then I had to graduate from there, closed on some properties, sold some properties, but I want to continue along the journey to developer. So I got into renovations and infill developments in the city, where we're buying properties, tearing them down, building them back up, building duplexes, triplexes, fourplexes, garden suites. We're doing all that in the Queen West, King West area. Did that for a couple of years, and then finally cashed out of those investments, and then bought my first land in Jackson's Point, Georgina, where we purchased 2 acres, and we started the process of getting 24 townhouses approved. And then ultimately now we have 7 developments now in the past 2 years. But the great thing was, majority of this growth on the development side happened in the pandemic. So where a lot of people saw pain, where a lot of people saw, where a lot of people were discouraged, and a lot of people were giving up, I saw opportunity. I always see opportunity where people are fearful, and I run and I attack, and I realize, okay, the market is frozen right now. Let's start looking for some deals. And where we start to see the deals were in mid-level land development plays. There was a lot of developers who were bleeding cash, and they need to exit out of some of their developments. So we were there with our team to scoop those things up. And it created an opportunity, created a weird opportunity, because then the real estate market started to then catch back on fire, and created this whole frenzy that we're in right now. But we were able to jump at it right in the beginning of the pandemic and scoop up some good plays, where we have almost 300 homes that are going to be constructed in the next 2.5 years, which is really a blessing for our community. Plus, Dreammaker has their projects coming as well. So just off the top of my head, I'm pretty sure that's about 500 to 600 homes coming to the Black community that's going to be offered, not only just for investment purposes, but also for people looking to get into the market as first-time home buyers. Like Richard mentioned in the beginning, we're moving into a state right now where, real estate's all around us, but it's really a scarce product right now, just because of how the city of Toronto and GTA and Ontario handles the planning process. And we have scheduled 1.4 million immigrants coming into the economy. That's now going to be your competition. But as a community, we never had anyone to identify or go to or lean on to get access to real estate. We're always in line waiting. But, if you're in line waiting for real estate nowadays, you're not getting real estate, because there's people who aren't in line getting fed real estate because they want to keep the wealth circulating in their community, circulating in certain hands. because it benefits the developer, the builder, and everyone involved. You know, if they give it to random purchasers, they lose control of that asset, they lose control of where that money is going. So it's one big game. So us as a community, we have to understand that when we're building wealth for ourselves, we also have to build wealth for each other and understand that every purchase that we're making and everything that we do has to be strategic to the T. Like, there's no mistakes, right? So, you know, purchasing real estate through Richard, doing real estate deals through Collins, Ian, you know, yes, there's hundreds and thousands of real estate agents, but you have to be committed to your circle and your network, because that's going to be the network that's going to continue to feed you opportunities. That's going to be the network that's going to continue to educate you. That's going to be the community that's going to continue to get you access to opportunities. We have to take that very serious, because other communities take it very serious, right? There's times where clients come to me and say, Aaron, I really want to work with you, but I have to work with this agent because they've been servicing my family for years and years. And I never get upset, never feel offended, because I understand that. And I understand that's what I'm trying to build for my community as well. I want to build exclusivity. I don't want to be for everybody, right? It's easy to be for everybody, but I want to be for our cause, because I understand that after I'm gone, you know, the generation coming behind us, they're going to benefit from it. So I want to make sure I make as many people in here as wealthy as possible. And it is possible. We just have to come together and understand and recognize that the time is now. So when I was listening to the presentation that Richard, Collins, Ian, and all the guys on this team were doing, I was smiling, because I'm like, this is the first time that I've seen kind of all this information jam-packed in one area. And I was saying to myself, I hope people don't take this for granted, but this was hard for us to find 10, 15 years ago. This was kind of like a small network of guys who spoke this type of language, and we spoke this language behind closed doors. And it's not because we're trying to be selfish. It was just no one was really trying to listen and hear about it, right? But it's good that everyone's now trying to get into that space of building wealth, because the world is getting expensive. Resources are getting limited, access is getting limited. So now is a time to really tap in. And then I saw a very important chart that Richard posted as well, where real estate used to be and where real estate is now. And real estate looks expensive right now, but with or without you, real estate is going to continue to move forward. So you got to ask yourself, are you going to get in the game, or are you going to sit in the sidelines and still hope that the market's going to pull back? But fundamentally, the fundamentals are there. The infrastructure is coming. Big corporations are coming into Ontario and the GTA. Immigration is coming. Approvals are moving slow. There's not enough inventory. What makes you think the prices are going to come down? The prices are only going to continue to go up. So now you got to ask yourself, how am I going to get involved? What product am I going to get into? What strategy am I going to apply? Who am I going to tap into to get a piece of this action? Then you got to assess your situation and say, okay, do I need more assets in my portfolio? Do I need more passive opportunities? Do I need a combination of both? Do I need more cash flow? Then you got to ask yourself, what kind of investor are you? What's your risk for appetite? Not everything is for everybody. So you just have to assess yourself, be true to yourself, and pick something that works for you. But you have to pick something. You can't pick nothing. You can't sit on the sidelines. I feel our community, we've always been okay with being passive, and we're not okay with being aggressive. And the reason why I'm aggressive in my business, and I show my aggression on Instagram when people say, oh, you're always doing something else, it's not really for me to show off or for me to highlight myself. I'm just trying to be an example to show you guys that this is the type of aggression you need to apply every single day, because every single day, every minute of the day, real estate's being transacted. Real estate is probably the most transacted product around you every single day. And it's very quiet, right? You're not going to know that that building just changed hands. That piece of land just changed hands. That condominium just got sold, right? Things are always transacting, and that's wealth going over your head. So you want to make sure you're in the game, you're in position. You're always seeking knowledge. There's always different things you can be doing. When I started out in real estate, I was buying a property a month. I was literally averaging a property a month, just by being involved, getting myself connected to the right people, finding the right situations, having professionals feed me opportunities. I'm just a normal kid and I knew nothing about real estate. I owned real estate before my parents even owned real estate. And then here I am today developing 7 development projects, 300 homes, over $300 million worth of development. And it was because of consistency and being deliberate in my actions and connecting and pouring out all my energy into this. So, you know, what we do over here at Golden Triangle Development, where I'm the CEO and the founder, we create multiple opportunities for you guys to participate in our development. And Collins mentioned it. Thank you, Collins, for the plug. I appreciate that. Not only can you invest in the asset itself, like the product, you can actually invest in the land as well. So this is taking it another layer. So companies like Tridal, Minto, Broccolini, TAC Development, Arista Homes, all the big players, everything starts with a vision. And then that vision gets brought to a group of individuals. Those groups of individuals then buy into the vision. And then that vision gets created, a product gets created, people buy that product, and then that makes a project. In our community, we usually come in from the max wholesale, which is pre-construction. You're buying it at wholesale and majority of the time retail. But where's most of the money made? In the beginning of the life cycle of the opportunity. So if you can come in to the opportunity before even wholesale and come in at manufacturing, that's where most of the money is made. So you're coming in from the manufacturing. So we're now entering the manufacturing stage of real estate investing, right? And we identify, like you guys, we're Black, African-American, African-Canadian. We're in this space, which is now offering you guys an opportunity where you can not only invest in the real estate asset from a wholesale perspective, but you can actually come in and invest from a manufacturing perspective, which changes the game. But it also gives you an option to invest passively. You might be in a stage in your life right now where you have too many properties, you're busy with your career, you're starting a new family, you don't want to take on any more properties to be a landlord, but you still want to make money in real estate. So, you know, here you go. You can invest in the development. As a development makes and turns over profits, you make a percentage of those profits based on your proportionate share in the development. So we set up a GP-LP structure, and Ian can explain that to you because he's an accountant. What that means is a general partnership and a limited partnership. So investors on this call will be a limited partner. So you don't have any say on the direction of where the project is going, but you're still an equity partner. You still have a partnership to the project, but your role is limited. But not only is your role limited, your exposure to the liability of the project is limited. So if the developer like myself was to get sued, it doesn't fall back on you guys. You guys just share on the profits of the project by investing capital into the project. So some other investors as well, they take advantage of the opportunity of investing in both, buying the asset plus investing in the development. So now this just adds another layer to what we're doing as a group and as a unit. And it starts with today, with continuing to support each other and understanding that you building the group, building the network creates more opportunities for you guys to continue to build wealth, where we put this thing on autopilot now, where we don't have to think about where are we going to go for an opportunity, where are we going to go for real estate, where are we going to go for development, where are we going to go if we need to lend capital. Everything is right here. It's just about plugging in and letting the machine turn itself. You have about 50 years combined, if not more, of real estate experience. But everybody on this call today and everyone who's presented, and I know personally because I work with them, are real estate investors. What you guys have to understand is real estate is nothing but a tool. And it's a tool that is used to create wealth for yourself and for your family. Real estate can be a home, yes, but it's a tool first to create wealth. So if it's simple as renting where you live and renting out what you own, or renting where you live and letting your investments take care of your rent at home, that's fine. We got to get out of this pride mentality that we have as a people and say, oh, I need to own where I live. No, if it makes sense to own where you live, Yes. But if you're going to work every day and you're paying that mortgage out of your pocket and you're house poor, that is not a comfortable situation. For years, when I owned 10 apartment buildings, I rented and I let that income coming in pay for my rent. It paid for my car payments. It paid for my vacations. It paid for my lifestyle. And I rented. And to this day, I still rent because I always want my investments to pay for my lifestyle. I always want to be flexible. I always want to keep moving. And a lot of people in our community, they fight me on that because they feel I'm saying don't own real estate. Yes, own real estate, own a lot of real estate, but don't be a slave to real estate. Real estate is supposed to create freedom and supposed to free you from any liabilities that you have. So you have to do it the smart way. You don't have, right? You don't need that $2 million home right now. You don't need that $2.6 million home right now. What you need to do is go buy a $2 million, $2.6 million multiplex that's going to service your life, right? Something that you can truly pass down to your kids, something that's going to continue to pay your family name for generations and generations. So I have a client who's on this call. I'm going to use him as an example, Kobe. He bought a fourplex with me in the pandemic, cheaper than what single family homes were going for in Toronto. And the multiplex is now paying for his mortgage at home while other people are going out there buying houses more expensive than the multiplex, and they're having to pay for that out of pocket. Which person would you want to be? So that's the difference between being a smart investor and being a foolish investor, not even investing at all, right? Sometimes you have to put away comfort. Sometimes you have to put away what you really want, and you have to build a foundation strong from the beginning so you're able to then really, truly enjoy the life you want. If you're trying to enjoy life and still have a $2.6 million home to be paying for out of pocket, you're always going to be stressed out. But if you do it smart, like Richard and the team were saying, buy multifamily, do Airbnb, buy your property, rent out the basement, build some type of income coming in, then you start to really build your life passively, take your equity out of your home, invest it in real estate development, invest it in private lending. Now you're putting yourself in position to really enjoy the lifestyle that you want because you're using real estate as a tool to create wealth. Once you build up enough cash flow and you build up enough reserve, then you can go buy that dream house that you're looking for and your assets are paying for it, right? And that's how the wealthy and that's how the successful communities do it. Clearly they don't share it and don't publicize it, but you know, that's how they do it. And all those assets are all tax write-offs. Everything that you do is a write-off. You get to pay down the depreciation of your asset while your property is going up in value. So real estate, it's a wealth hack that if it's done correctly and emotion is stripped from it, there's a lot of wealth to be created. So I appreciate you guys for giving me your time, allowing me to tell my story and my journey, allowing me to share where we are today. But just to recap, we have 300 homes that we're going to be building in the next 2.5 years. These are tools that you guys can all use to create wealth for yourself and for your family. You can come in on the land development side. You can come in on the asset side. You have the professional leaders here, Collins, Richard, Ian, and the other gentleman that came on. I didn't catch his name, my apologies. That can guide you and direct you to us. And we can come back and present our opportunities to you. This is for you guys. This is for us. This is for us to pass on to our kids. This is for us to have access. You know, we launched our first project in Brampton, Maine, and Clarence. We haven't even launched yet, but we opened it up to our database. 85% of our purchasers are our people, and I'm very proud. And 75% of our investors are our people. So the formula is working, guys, and there's room for more of you guys to come in and tap in and get involved. And I hope to see you guys soon. Thank you very much. Appreciate it.
Wow, that was amazing, Aaron. Honestly, I hope everyone's really listening carefully in how he was talking, because I was paying attention to his words, and he kept saying our, we. You know, he's the collective. You know, it was never about him and me. You know, it's our, we, and that's what it's about. Honestly, the fact that there's still 70 people on right now, this has to mean something. Right now, it's the final day of Black History Month, but it's actually the start of Black history. We're
Yeah.
making history right now. You know, if everyone really that's still on this call and you're really taking this serious, you know, then, you know, like, yes, oh, I see some claps and fire emojis. Honestly, Aaron, you give so much information. You went over our heads on a lot of stuff. But guys, this is what we have access to. Like, you know, he's a resource, he's here, he's open, he's just sharing his whole story, sharing the ups and downs that he's gone through. So even if you're hesitant, you know, and you mentioned that as well, you know, that a lot of people are hesitant. They don't want to make that step, right? But when you have professionals, you know, that are in the game that have gone through it numerous times, they've probably gone through those hurdles that you're scared of, you know, and you just ask them and they have the answers for you. You know, that's what we're trying to do. That's the community that we're trying to build. I got to bring the map book in here again as well, because the map book and the Create Wealth Network, you know, we're looking to build, and, you know, that's what we're looking to build, a network of this kind of people who are interested in this kind of information, you know, so I understand, I appreciate that. And then Aaron, before you fully sign off, but we're going to get into a Q&A before we sign off. But Aaron, if you don't mind talking about where these developments are going to be built, you know, and how people can actually get into them.
Yeah, no, thank you, Richard, and thank you everyone for the claps and applause. But this is really for you guys. You know, a lot of people always ask me, like, Aaron, why do you spend so much time just pouring out? I'm just like, you know, I never got into real estate for just me, and I always want to bring people along because I always believe the vision could always be expanded and we can always grow. And with that behavior that I've developed from such a young age, here I am as a developer, and I'm only here as a developer because of the backing of my people coming together, purchasing the land together, creating the product together. But we want to get even bigger so we can have our own ecosystem. We don't have to depend on anyone else's ecosystem, where we can feed our people and have 5,000, 6,000 homes in the next 10 years and be solidified in the industry where we have to be respected as a people. So that's my life mission, and that's what I'm all about. But right now, we have a site in Brampton. We're building 90 stacked townhouses. So that's at Main and Clarence, downtown Brampton. Then we have 24 townhouses that's coming to York Region, Jackson's Point, Georgina, right on the Lake Simcoe. Beautiful property. Great property for investors who are looking to Airbnb, have a secondary home, or, you know, you're looking to relocate. You're still in York Region. You're right after Aurora. So there's 24 townhouses there. Then we're building 60 stacked townhouses in Ajax on Roslyn Road West. We're going to be starting sales in the summer. Then we have 98 stacked townhouses that's going to be coming in Ajax as well, off of Audley. That's in negotiations right now. That should be firming up shortly, but that'll be another 98. And then we have 74 townhouses that are going to be coming to Whitby. And that will be in 2024. We're going to be starting that. So yeah, we have a lot of good products coming, and every day things are on the table. And we're also building a 10,000 square foot plaza in Bowmanville. That's already under construction. And then we're building an apartment building downtown in the Annex, which we're starting construction on that soon as well. So there's also, you know, there's going to be another division that we're going to be opening up, not only for development, but value add properties, where we're going to be bringing together investors, purchasing apartment buildings and cash flowing assets and holding for the long term, and building wealth with our communities as well. So I saw that you guys mentioned JV partners, the ecosystem coming together. So that's kind of like what we're going to be building as well. So kind of like Starlight, how they kind of put together a portfolio of apartment building and cash flowing properties, and people invest and they get the paid dividends out of it. That's kind of the next direction that we're going to go. So stay tuned. The fund is going to be called Excellence, with a Black background. So if you need me to tell you what that means, then, you know, we'll talk offline. But, you know, it stands for Black Excellence, but it's really just excellence. And the tagline is Invest in Excellence. So that's our next push that's going to be coming to go alongside our developments, building a fund where individuals, investors can come together as a collective group and own prime real estate in the GTA. You know, real estate is expensive. We know that, but we don't look at prices when it comes to real estate. And that's another thing we got to stop looking at price. You got to look at value. Is there still value in that real estate? And then you reverse engineer it. But a lot of us look at the number, oh, property's $1 million. Okay. But if you add value to it, could it be worth $2 million? If the answer is yes, then there's value. It's still a good deal. So, you know, I'm just proud of what you guys have done tonight. We've been here for 2.5 hours, jam-packed. Everyone's still got energy.
Yeah, I want to just get into a
information.
Q&A. You know, if there is any questions, please let's open the floor. You know,
Let's
Aaron,
do it.
thanks a lot. No, we really appreciate your time, and Jeff as well. If you don't mind coming back on, Collins. You know, Bert, I don't know if Bert's with us. Ian, I know it's his birthday, he's celebrating, but you know, and I'm sure there's other people that probably have properties right now as well. So, you know, if there are questions, please ask questions. Okay, ask questions, and let's make this a form of action. Like, I really don't want this to just be a discussion. And then after I was like, oh yeah, well, that was so great. I'm so motivated, right? And then don't do anything afterwards. Like, you know, we got to take action. You know, the form, I just sent it to everyone as well. Fill out the form. Let us know your situation, where you are, where you stand right now with real estate, and then let's take some action steps. But does anyone have any questions? You can open your mic up. Just type in a box there.
I have a question for Aaron. So I think he had indicated that there will be opportunities, or there is opportunities for us to actually invest in the development. Is that going to be like another session, or is that like, how do we go about reaching out to him or his team? Find out more about that information.
Hi, is this Shaz?
Yes, it is. And I'm the one that said, like, I would like to come work for you. But yes.
Awesome. Hi, Shaz. Nice to meet you. Yes,
You
there
as well.
are current opportunities right now available. We have investor meetings weekly, sometimes daily, for investors. I saw a question as well as what's the minimum investment? Minimum investment is 50K, but we have a whole governance and qualifying process. So you have to qualify to get into the investment. It's nothing too crazy, but it's just to make sure that the investor can handle the investment. But yes, to answer both questions, there are opportunities available. The Durham opportunity has opened up where investors can invest into the Durham projects, which is Whippy and Ajax, and the minimum subscription is $50,000.
And
you can reach out to Richard Collins to book an appointment, and we'll be glad to do a formal presentation and send out the project decks to you guys, and then hopefully we can get you guys involved.
does the investor have to be an individual, or can it be a corporation?
You can be a corporation as well.
Okay, perfect. Thank you.
No problem.
All right, any other questions? So guys, what they just mentioned there too, you know, again, we can pool together funds, right? So everything that he's talking about is doable, right? Whatever your situation is, even if you have 10,000, 20,000 that's available, or even if you're building from there, you know, anything matters. It's just, if you have any questions that can give you that next step, you know, please just ask that question. You know, we'll give it about 5 minutes and then we'll wrap up the call. Anyone else have any questions? Type them in, or please open your mic up.
There's a question here where it says anything in Guelph for the near future. I don't know if that's directed to me, but
Well, anything.
as of
Well,
right,
yeah, I think maybe they're, because you're talking about a different area, so maybe they're asking if we have anything coming in Guelph.
yeah. So I currently don't have anything in Guelph, but what you have to understand about real estate investing is it's okay to invest outside your backyard, right? You go where the money is. A lot of investors make that mistake where they want to invest where they live. And sometimes where you live might not be the best opportunity at that time. So you have to stay flexible, and you have to be accommodating to the investment. It could be through a development, or it can even be through buying a hard asset through Richard and his team. It's don't get caught up on location as much, just get caught up in fundamentals. And if as another area has better fundamentals and stronger numbers, that's where you kind of want to drift to.
Yeah, for sure. And then also I want to add in terms of, you know, how you're viewing the real estate. I just want to bring a quick story up what happened to me last year. I was in Brantford, right? And I had some clients that, you know, were looking at some property, and, you know, they're going back and forth with the floor plans, you know, the site plan, they're looking at the different lots. Oh, do I get this one, that one? You know, looking at the bedrooms and the washrooms. So we're there for probably like 30 minutes, right? And then two Indian gentlemen came in. One was an agent, I guess the other one was a client. They walked in, and right away they went to the site plan. They said, "What's available?" And so these are available. Okay, we'll take this one and this one. They didn't look at no floor plans. They didn't look at anything. How they're viewing real estate is how we need to start viewing real estate. And what Aaron's trying to say, the location. Don't worry about location. Don't worry about price. Don't worry about, just know that it's going to appreciate, right? Aaron, if you want to back on that.
Yeah, exactly. Like at the end of the day, you wanna still have your parameters, but you have to understand that real estate is in an upward swing right now. You don't want to be overpaying for real estate, but you have to understand that the prices that you're hoping to get 2 years ago is not going to come back. So you gotta adapt. Like the saying, if you don't adapt, you'll die. So you have no choice but to adapt and move. You just have to make sure that there's a strategic play behind it. Know your exit strategies.
Margaret is asking Jeff, you can open up your line too, and Collins as well, if you guys have these answers. How often would you recommend a construction mortgage? I don't know, anyone want to talk on that? How often, that's Margaret, how often would you recommend a construction mortgage? I don't know, Margaret, I don't know exactly what you're saying. Collins, so you want to say something?
Yeah, maybe a refinance, maybe is what she's referring to. Or
Margaret, are you referring to refinance?
Margaret, you can unmute to clarify. Oh, no, for new builds.
For new builds, a mortgage for new builds. So with pre-construction, also remember, with pre-construction, you don't have to set up the mortgage until you take possession of the property, right? So what you're doing is you're making deposits, you're making down payments onto the actual property. So these are deposits that you're putting down, but the mortgage is not until you actually close. And for condos, they even have an occupancy date, and then they have a closing date. So occupancy means that you have possession of the property and you still don't have to have the mortgage kicked in. So at that time, some builders, I don't know, Aaron, how you have yours set up, if you allow them to have tenants in that period, but a lot of builders are offering that. So you can have a tenant in there before even your mortgage kicks in. So, don't worry, the mortgage is not actually fully in until you actually close the property. Hopefully that answered your question. Okay, perfect.
Just to piggyback off of that, another thing that a lot of people don't know is that because of what Richard just said in terms of the actual date when you need the mortgage, technically you could have multiple pre-construction properties going at the same time. Obviously, be careful about over leveraging yourself. But if you had multiple partnerships with multiple different groups, so me and Richard had one pre-construction, me and Aaron had another pre-construction, me and Ian had another pre-construction, well then technically I have 3 pre-constructions that I have vested interest in, but technically I don't need a mortgage, or they don't register against me personally until I actually need to get a mortgage for said development. So do what you will with that information.
Yeah, thank you for that, Collins. And again, I'm posting the form here again. Please fill out the form so we have at least your email. We know that you're interested in getting more information and actually taking action and going and getting more properties, So, okay, so I think we have another question there, or oh, no,
yes, can I ask a question?
Okay, go ahead. That's Abby, right?
So, yes, I wanted to know, is it always a good idea to get a pre-construction with the hopes of reassigning?
I can jump in and answer that question if you don't mind, Richard.
Yeah, please.
You never want to get into real estate with one strategy in mind. So yes, an assignment is an option, but you gotta make sure you're in a position that you can close. So don't go into when you go into pre-construction, do not go into with the intention of I'm going to flip. Make sure you can qualify, make sure you have your lenders, your capital in place, that if something goes wrong, you can handle it. Because if you assign that property and that person doesn't close on it, you're still responsible for it. If you can't assign the property, you're also responsible for it. And if you don't close, you're in default and you can lose your deposit, and you can put yourself in a position for litigation and lawsuit as well. So don't look at it from a short term, look at it as a long term, look at it as you're going to go to the finish line. And if you have the option to get out early and you're secure with that exit, you can do it. But don't go in with the short term in mind. I've seen a lot of people get burnt that way.
Okay. But I mean, realistically, how many can you possibly close on, right? If you're not looking at...
the strategy for closing on multiple pre-constructions, and I've done it, is you want to spread out the closing. So if I'm buying a pre-construction and it's closing in 2022, then I'm not buying the other one I'm not going to buy another one that's closing in 2022. I'm going to find a project that's closing in 2023, then a project that's closing in 2024. So you want to be able to spread it out to the best of your ability to give yourself enough bandwidth that if something was to happen, you have an exit strategy. So you don't want, I've seen a lot of people buy 4 projects in 1 year. I'm like, dude, how are you going to close all of these at the same time? And then they're like, so what would you suggest there? And I'm like, find a project that's closing at least 6 to 8 months away from each other, right? And then you can give yourself that safety net. So if something happens or cash is short, you have enough runway to protect yourself. When you're investing in real estate, you always want to protect yourself. You always want to make sure that if the worst case scenario happens, can you be prepared or can you handle it? If the answer is no, don't get into it, because it's hard to correct your mistake in real estate because it's such a heavy machine to catch when everything's falling apart. So don't overreach and don't think too short-sighted. Always think long-term.
I have a question, if I can ask.
Of course.
Thank you.
No problem, Abby.
So if you're buying a property, for instance, somewhere like Whitby or Kitchener, or somewhere not in your area, like how do you know if you're gonna get somebody to rent that place? Like how, like in terms of renting, like how are you sure that, okay, if I'm gonna get this and I want to rent it out, like if you have the idea of renting it out, but how do you know that that place is good enough, like it's a good place for people to rent?
Are you talking to me, Chris? Okay, so what I do personally is you want to gather as much information. Okay, so before you buy any property, you should know where you're already going, right? Yes, the realtor is going to show you properties, but you should already know where you're going to go because you did the research. So you're going to go online, you're going to check an Altus report, see what the rental rates are going for, see what the rental vacancies are. You're going to want to know what the fundamentals are in that area, walk scores, transit. You're going to want to know where the hospitals are. You're going to want to know the crime rate. You're going to want to know the average income. You're going to want to know the ethnicity in that area. You're going to want to know, is it a college town? Is it a working professional? You're going to want to gather as much information as possible before you actually start going to look at property. The problem is people go shopping first and then don't know how they're going to actually pay for this property or they're going to maintain this property. So you want to actually do the reverse. So, and there's no pressure when you're doing this research because you're not actually committed to anything. You don't have any time constraints. You don't have any budgetary constraints, restrictions as well. So you want to spend as much time as you can doing the research. The research part is what a lot of people skip because it's boring. But the research part is what's going to save you hundreds of thousands of dollars if there's a mistake that's made. So you want to do your research. You want to talk to as many people as possible. You want to find realtors in that area that are specialized. If your realtor is an out-of-town, if your realtor is an out-of-town realtor, you want to bring your realtor to probably come and meet these other realtors and get their view on things. Even if you have to pay that realtor a couple $100 for their time, you want to make the best informed decision as possible. The other thing you want to do if you're looking at multifamily, you want to talk to the property manager because the property manager has experience dealing with the building. So he's going to tell you everything about this building. Then you're going to want to talk to the tenants because the tenants are going to give you the truth about who's a noisy neighbor, who's a party guy, who's whatever, what things are taking place. And then you're going to want to then go shopping and know where you want to be. And then you're going to be patient and wait for that property that comes up in the area that you did that research on. So as an investor, you want to be patient because it's your money that you're investing and you want to make sure that you're protecting your investment. So you want to make sure that you're making the best decision as possible. And you don't want to be rushed into that decision. So you got to take that due diligence part very serious. So when we're doing a real estate development project, our due diligence process is about 3 months to 4 months. of just finding information, gathering information, looking for things that can harm us in our investment, and then cross-examining that with the environmental studies, geotechnical, hydrotechnical, meet with the city, the planners. We take the due diligence part very, very serious, because once you buy the property, you're stuck with the property, and that can drain thousands of dollars out of your pocket every month, or it can put you in a negative loss as well. So make sure you take your due diligence very serious.
All right, that's amazing.
Thank you.
That's amazing. Thank you very much. Honestly, we thank God for this session that we have. You know, just how things come together. You know, it's this is something, like I said, I did 2 years ago. We had a pretty good turnout, right? But this right here, it trumps that big time. You know, and I'm so grateful for everyone, you know, that wanted to participate in it, because that's how it grows, right? And you know, that's why I'm really honored to have you on, Aaron, because you extended yourself to us. You get what I'm saying? Like, it's something that you had to do. You had to make that extension and say, hey, you know, let me talk at this, and of course we're gonna say yes, you know, because you're just blessed it right now. Look, you got all these answering all these people's questions, and that's what it is. That's the one thing that's slowing people down, just the questions. And I hope we got to answer as many questions as we can. And we're going to be recording this as well, so you'll get the replay. Everyone that registered will also get the replay. You know, you could go through if you missed anything or anything. I see Billy Jane said she missed a few because she got logged out. But, you know, watch the replay. And, you know, on the forum, if you want to see more of this, please let us know, because we want to keep doing it. You know, thank you, everyone. Have a good night. God bless you. We appreciate you. And thank you for staying with us for 3 hours. That's amazing. All right.
Thank you, guys. Appreciate it. Have a great day.
Thank you guys. Have a good night.
Bye.
Good night.
Thank you, guys. Take care.